Please like, share, and subscribe. Wishing you happiness and good luck every day.
You know, we love to celebrate the wins, don't we? The stocks that go to the moon, the brilliant market calls. But what if I told you the real wisdom, the kind that actually builds wealth over a lifetime, isn't found in those victories at all? What if it's hidden in our mistakes? Today, we're digging into the minds of some legendary market wizards to understand the powerful and frankly surprising psychology of getting it wrong. Let's get into it. Okay, let's start with this single idea right here, because it's the key that unlocks everything else we're going to talk about. Good decisions sometimes have poor outcomes. Now, that might sound simple, but it goes against everything we're taught. We're conditioned to think that if something went wrong, we must have screwed up. But what if that's just not true? What if you can do everything right and still lose? So let's get one thing straight from the jump. In the world of investing, mistakes aren't just a possibility, they're an absolute guarantee. They are, quite literally, the price of admission. It's the cost you have to pay for a shot at returns. So the real question isn't if you'll make them, but what you're going to do about it when they happen. I love this analogy because it's perfect. Think about a game of chess. All the pieces are right there on the board for everyone to see. It's a game of complete information. If you're skilled enough, you can pretty much map out the future. But investing? That's not chess. That's poker. You can see your own cards, your research, your analysis, but you have no idea what cards the rest of the market is holding. You're just playing the odds. And sometimes, even when you play a hand perfectly, you can still lose to a lucky draw. And this brings us right back to that crucial question. The masters, the wizards, their answer is a resounding yes. Of course it was a good decision. See, the quality of your decision has to be judged based on your process and the information you had at that moment. The outcome, that's a mix of your process and, well, a little thing called luck. The biggest mistake of all is trashing a good process just because you got unlucky once. Okay, so if we're going to accept that mistakes are inevitable, the next logical step is to really understand them. Because it turns out not all errors are created equal. The market wizards tend to split them into two main categories. And believe me, the way our brains handle them is wildly different. First up, you've got the error of commission. This is the one that really stings, you know? It's when you actively did something. You hit that buy button on a stock, and then you watched it just plummet. You took an action, and that action led to a very real, very painful loss in your account. It's obvious, it's immediate, and there's no hiding from it. The responsibility feels like it's all on you. And then you have its sneaky twin, the error of omission. This one doesn't hurt right away. It's the one that kind of haunts you years later. It's the opportunity you saw, you thought about, but you didn't pull the trigger. You failed to act. You didn't buy that stock that went on to become a massive multibagger. You didn't technically lose any money, but you missed out on a life-changing gain. And this is where the psychology gets really fascinating. According to investor Sanjoy Bakshi, our minds treat these two errors completely differently. The error of commission, where you bought the wrong thing, feels like a direct hit because, well, you pulled the trigger. But the error of omission, that one's way easier to explain away. You can tell yourself, oh, I was just being prudent, or I was busy, I was asleep at the wheel. It might hurt down the road, but the immediate pain is so much less, even if the financial cost of that missed opportunity was 100 times bigger. So, if the biggest mistakes aren't just about bad luck or even a bad process, where do the really catastrophic ones come from? On this, the wizards are pretty much all in agreement. The biggest risks you face aren't in the market, they're not on a balance sheet. They're sitting right between your own ears. I mean, just think about it for a second. What do you think it is? Market crashes, high inflation, a disruptive new technology. I mean, sure, those are all huge challenges, but they're not the number one reason why most investors fail to reach their goals. Not even close. The answer, as this slide so perfectly puts it, is staring right back at you in the mirror. It's us. We think we're these rational, logical beings making calculated decisions. But the truth is, so much of what we do is driven by these powerful, deep-seated psychological biases that we're often not even aware of. And here they are, the usual suspects. You've got ego, the little voice that tells you you're a genius and can't possibly be wrong. Then there's FOMO, the fear of missing out, which is just pure poison, pushing you into crowded, overpriced trades. Envy, seeing your neighbor get rich on some hot stock and deciding you have to jump in. And complacency, getting comfortable and thinking the good times will last forever. These are the internal demons that will wreck your portfolio if you let them. And if you think this is all just academic theory, listen to this story from the legendary investor Vijay Kedia. It's a truly chilling reminder of what's at stake. He saw all the warning signs about a company he owned, but his ego just refused to let him admit he was wrong. He held on, he even doubled down, and eventually the company went bankrupt, to zero. His point about the fine line between healthy self-belief and destructive ego, well, that's a multi-million-dollar lesson right there. Okay, that was a little heavy, but the good news is, once you've identified the problem, your own psychology, you can actually do something about it. The masters, they don't get rid of their biases. They're human, after all. What they do is they build systems. They build processes specifically designed to keep those biases from taking over the controls. They create their own personal rulebook. So what does that rulebook look like? Well, it's something like this. This is the antidote to that ego-driven mistake we just heard about. First, you build a crystal clear thesis. Why exactly are you buying this thing? Second, you test that thesis with cold, hard data, not just a feel-good story. Third, and this is huge, you actively go out and find people who disagree with you to expose your own blind spots. And finally, you decide ahead of time what would prove your thesis wrong, so you can reevaluate without emotion. It's all about building a structure that saves you from yourself. I absolutely love this little 2x2 matrix. It's such a brilliant way to think about your decisions. Look at that top row. The goal isn't just to get a good outcome. The goal is to always have the right process. If you've got the right process and you get a bad outcome, that top right box, that's just bad luck. It's disappointing, but you move on. But that bottom left box, a wrong process that leads to a favorable outcome, that is the most dangerous place to be because you just got rewarded for doing the wrong thing, and you're going to learn the wrong lesson. 90%. Just look at that number. What do you think that represents in the world of investing? Most people think long-term success comes from finding that one magic stock, that one genius move that changes everything. But the data? Well, the data tells a very, very different story. According to the research, up to 90% of your portfolio's performance doesn't come from picking the right stock. It comes from your asset allocation, your systematic, strategic process for how you divide your money. It's not sexy, it's not glamorous, it's not about being a hero and finding the next big thing, but it is what actually works. Process, time and time again, absolutely trumps prediction. And that brings us to our final and maybe the most important point of all. If you can truly master this one thing, you can survive and thrive in any market. It's all about learning how to lose well. It's about completely reframing what a mistake even is. It's not a failure. It's data. It's the ultimate tool for growth. This insight from Sanjoy Bakshi is it's so profound. The second you attach your sense of self-worth to the outcome of a trade, you have already lost the game. A stock going down doesn't make you a bad person. It doesn't make you a stupid investor. It's just an outcome in a game of probabilities. When you personalize it, you just paralyze yourself. You crush your own confidence, and you make it impossible to make a clear-headed decision next time. So it really all comes down to this: ownership. You've probably heard that famous political phrase, mistakes were made. It's a classic way to avoid responsibility. But that phrase, mistakes were made, but not by me, that is the absolute death of learning. The moment you can actually say the words, I made a mistake, that's the moment you unlock the ability to analyze it, learn from it, and make sure it doesn't happen again. And in the end, this all leads to the final piece of the puzzle, humility. It's not a weakness, it's a genuine superpower. Being able to admit you were wrong, to even laugh at some of your past blunders, it makes you a better investor. It keeps that ego in check. It reminds you that before you're an investor, you're a human being just trying your best to navigate a world of probabilities, not certainties. So we end right where we started. Mistakes are not the problem. They're a given. They are the tuition you have to pay for an education in the markets. The only thing that truly separates the amateurs from the masters isn't that the masters don't make mistakes. It's that they are relentlessly committed to learning from every single one. So the only real question left for you is, what are you going to learn from yours?
All right, let's dive into the story of a true maverick of the market, Samir Arora. Now, we're not just going to talk about his big wins because, honestly, that's only half the story. We're going to get into something much more interesting, his powerful philosophy on making mistakes. You'll see that for Arora, mistakes aren't just something to be avoided. They are the very bedrock of his success.
And this quote, wow, it just gets right to the heart of it, doesn't it? For Samir Arora, a mistake doesn't end the story of your investment or your career. No, it is the story. That mess up becomes a critical plot twist, a moment that changes the direction of the whole narrative and, if you play it right, actually makes it better. It's just a fantastic way to think about the setbacks we all inevitably face.
So, here's our game plan for today. We're going to start with the early pivots that really set the stage for his entire career. Then, we'll look at how he mastered the blend of gut feeling and cold hard data. After that, we'll cover the massive storm that almost took him out and the brilliant art of elimination that came from it. And finally, we'll wrap it all up into a game plan that you can actually use in your own life. Okay, let's get into it. You see, to really get Samir Arora's mindset today, you have to rewind all the way to the beginning. His whole career is basically built on one skill: the willingness to admit he was on the wrong track and have the guts to make a hard turn. And this wasn't a weakness. It turned out to be his foundational strength, his superpower. You know, what's so interesting about this slide is that it looks like this perfect, straight line of achievement, right? But the real story is so much messier and more relatable. Arora actually wanted to be a chartered accountant, but he got into IIT for engineering. And as he said himself back then, no one refuses an IIT admission. So he went. He even came third in his class, but he knew in his gut it wasn't for him. So he pivoted. He used more education, first at IIM Calcutta and then Wharton, to strategically course-correct his way into the world of finance he actually wanted to be in. So this is the key takeaway right here. For Arora, realizing you're in the wrong major or the wrong job isn't a failure, it's just data. He saw every misalignment not as a disaster, but as a blinking sign telling him he needed a new plan. He literally studied his way out of a career he didn't want and into one he did. He wasn't just reacting to problems, he was actively steering his life. Now, this ability to pivot wasn't just about big career moves. It actually shaped his entire investment style. Once he landed in finance, he developed this really unique approach. It wasn't just about the spreadsheets and the numbers. He learned to combine that deep, analytical work with a really well-honed intuition. And that's what allowed him to spot these massive opportunities that everybody else was just completely missing. And this is just a perfect example of what I'm talking about. When Bharti Airtel had its IPO way back in 2002, pretty much every analyst was obsessing over the PE ratio. But Arora, he was asking a totally different and much better question. He was looking at the size of the opportunity. He looked at what happened with telecom in China and the US and realized the potential in India was just astronomical. He wasn't valuing the company as it was, he was valuing what it could become. And here's the thing, he didn't just get lucky once. He developed a playbook. He started seeing the same pattern over and over again in the Indian market. And look at this checklist, it's so clear. A private company going up against a big state-run one, led by fantastic management, using technology and better service, and with very little political meddling. This simple checklist led him to jackpot investments in HDFC Bank, Kotak, and Bharti. It was a repeatable formula. This quote right here is just essential for anyone trying to understand modern investing. Arora took that same forward-thinking logic and applied it to new-age companies like Zomato. He got that a company could be bleeding cash on paper, but was actually using that money to build a fortress, a business that could dominate for years. Today's numbers don't always tell you the story of tomorrow's profits. Of course, every great hero's journey has a turning point, right? A moment of real crisis. And for Samir Arora, after years of incredible success, he was about to face the ultimate test. He was about to learn a brutal lesson in humility, and it would change his entire approach to investing forever. Just one number: 2008, the year of the global financial crisis. I mean, it was a wake-up call for the entire planet. And for Arora, it was a deeply, deeply personal and professional reckoning. So what was the big mistake? Well, it was a classic investor trap. He got overconfident. As he put it, a nasty bout of overconfidence. He truly believed that the Indian market was special, that it was somehow walled off from the chaos unfolding in the US and Europe. So he stayed fully invested, and he paid a very, very heavy price for that belief. I absolutely love this analogy because it's so vivid and it's so true. It just perfectly captures that aha moment he had. He suddenly got it. It doesn't matter how solid your own house feels. In today's world, the global financial system is so interconnected that a crazy party on the other side of the planet will shake your foundations. There are no safe little islands. And this, right here, is the profound lesson that came out of that crisis. It's not about trying to hit a home run with every swing. It's about making sure you don't get knocked out of the game. To have any chance of winning in the long run, you have to survive the bad days. It's that simple. Protecting your capital isn't boring.
It's the ticket you need to stay in the game for future wins. So, forged in the fire of 2008, a whole new, more mature philosophy emerged, and it's built on this really interesting, kind of counterintuitive idea. Instead of spending all his energy trying to find the next perfect stock, he starts by focusing on what to avoid.
And just look at how practical and simple this is. He argues that it's way easier to identify what's obviously bad than to know for sure what's going to be great. So he starts by just cleaning house. Companies with sketchy leadership, they're out. Insanely high valuations that make no sense, gone. Companies with shaky finances, see ya. And only after he's filtered out all the potential landmines does he start digging into what's left.
Now, this slide is where you can really see the genius in how he built his portfolio. He basically divides his money into two buckets. The first is for companies where he has high confidence they'll deliver reasonable, solid returns. The second is for companies where he has reasonable confidence they could deliver very high returns. But notice what's missing here. There's no bucket for high confidence in high returns. He believes that combination is a recipe for disaster because it leads to putting all your eggs in one basket.
And this is the mantra that holds it all together. It's just a powerful statement of intellectual humility. It's his way of saying, hey, the future is a mystery. It's fundamentally unknowable. And if you truly accept that, well, then the only logical thing to do is to diversify. You have to manage your risk precisely because you can never, ever be 100% sure about anything.
Okay, let's pull all these ideas together. What can we really take away from Samir Arora's incredible journey? Because these aren't just rules for the stock market, you know? This is a whole philosophy for making better, smarter decisions in any complicated area of your life.
And here it is, laid out perfectly. Rule 1, just accept that mistakes are going to happen. Think of them as the tuition fee you pay for your education in the real world. Rule 2, learn the lesson. Making a mistake is fine, making the same mistake over and over is not. Rule 3, be proactive. Use that elimination strategy to avoid the really dumb, unforced errors. And finally, Rule 4, always have a safety net. Diversify your bets so that one bad call can't wipe you out.
But here's the final and maybe most important piece of the puzzle. You might not expect this one. Arora is convinced that the true foundation of good decision-making isn't a spreadsheet, it's mental peace. He argues that if you're feeling frustrated or angry or unfulfilled in your personal life, you're way more likely to make reckless, ego-driven mistakes with your money. A calm, balanced mind is your single greatest asset.
So, we'll end on this question for you to think about. Using Arora's philosophy, think about a recent mistake or a misstep in your own life, whether it's at work or at home. Instead of just beating yourself up over it, how can you reframe it? What's the plot twist it's trying to introduce into your story? What's the tuition fee teaching you? Because that little shift in perspective, that might just be your next big breakthrough. Thanks for joining us.
All right, let's dive right in. Today, we're cracking open the playbook of an investor who you may not hear about every day, but who is deeply, deeply respected by those in the know, Sanjoy Bhattacharya. We're not just going to look at his wins and losses. We're going to explore the entire philosophy he's built, a philosophy grounded in humility, a constant hunger for learning, and most importantly, a really profound understanding of human error.
Okay, this quote right here, it's basically the key that unlocks his entire way of thinking. This single idea governs his approach not just to the markets, but, to life. For Bhattacharya, the biggest risk you face isn't some crazy market crash. It's the enemy inside your own head, your ego. And that idea is the bedrock of his whole investment framework.
So, who is this guy? Well, first, get that image of a fast-talking, screen-staring market guru out of your head. That's not him. Think more philosopher, a perpetual student. His wisdom doesn't come from trying to predict the next hot stock, but from a place of deep, almost insatiable intellectual curiosity. And here's what's so cool about his approach. His learning isn't just about finance. He's at his happiest when he cracks open a book that gives him a powerful new way to think, a new mental model. It doesn't matter if it comes from psychology or physics or statistics. He gets that the best insights, the real breakthroughs, often come from way outside your own little bubble.
This list here, these are like the foundational pillars of his thinking. And just look at the themes. You've got Seth Klarman's margin of safety. That's all about managing risk. You've got James Montier, who is obsessed with behavioral psychology. And Charles Ellis's Winning the Loser's Game. That's all about knowing your own limits. Every book on this list is another brick in his rational, risk-first foundation.
But listen, he wasn't born with this fully formed philosophy. No way. Like any great investor, his wisdom was really forged in the fire of his own screw-ups.
So let's look at how his thinking evolved, from a really simple, almost naive idea of value to something much, much more robust and sophisticated.
This slide just sums up his whole journey perfectly. Early on, like a lot of us, right? He'd see a low price-to-earnings ratio, basically a measure of how cheap a stock is, and he'd think, hey, that's a bargain, that's value. He just kind of assumed the numbers would work themselves out. But boy, did experience teach him a tougher lesson. The after column, that's where the real gold is. It's an obsession with the quality of the business, the character of the people in charge, and a balance sheet that can take a punch. The big lesson here is that real value investing isn't about finding what's cheap. It's about finding what's durable.
This is one of my all-time favorite lines from him. It just perfectly captures his healthy skepticism. I mean, think about it. Why would you waste your time in management meetings or reading analyst reports? The barber is always going to tell you that you need a haircut, and management is always going to sell you their story. He'd rather let the cold, hard facts and the numbers do the talking.
So what does he focus on instead? This. This is his core checklist. And I want you to notice the order. The very first question isn't how much money can I make, it's what can go seriously wrong. He starts with defense, not offense. He stress tests everything for durability, he digs into the integrity of the people running the show, and he looks at the accounting, not just as numbers, but as a story about management's character. Okay, now we're getting to the absolute heart of his playbook. And honestly, this might be the most powerful lesson for every single one of us. It's his totally counterintuitive view that mistakes aren't just things to be avoided, they are in fact your most essential learning tools. They are an asset, but only if you know how to use them. Seriously, just let that sink in for a second. He's forcing us to completely reframe how we think about failure. Instead of beating ourselves up over a bad call, what if we started looking at every mistake as a tuition payment for a lesson we couldn't have learned any other way?
Now, here's a crucial point. Not all mistakes are created equal. He splits them into two big categories. Errors of commission, that's when you do something, you pull the trigger and buy that stock, and it goes south. That's a direct loss. Then you have errors of omission. That's when you don't do something, you pass on a stock that then goes to the moon. He argues, and I think he's right, that avoiding those first errors, the ones of commission, is what keeps you in the game. They can wipe you out. The other kind, the missed opportunities, they're going to happen. You can't catch them all. So you've got to learn to be a lot less hard on yourself for those.
The reason he can learn from his mistakes is because he has absolutely zero ego about making them. He just owns it, openly. This kind of brutal honesty is what lets him look at his errors objectively instead of trying to defend them or make excuses. It's a genuine superpower.
And this story, this just brilliantly illustrates the flip side. He tells this incredible story about buying a stock called SSI, based on nothing more than a flimsy tip that he saw a bunch of cycles piling up outside their office. He did zero real homework, and the stock went up, wait for it, 500 times. But he calls it a lucky fluke. Why? Because a good outcome doesn't automatically mean it was a good decision. He had a terrible process, got incredibly lucky, and, this is the important part, he knew it was luck, not skill. That's how you avoid becoming overconfident. So how do you actually turn this into a system? Well, he has a really simple 3-step framework. First, you acknowledge it. You just own the mistake, no ego, no excuses. Second, you analyze it. You go back and figure out, where did my thinking go wrong? And third, you apply it. See, the goal isn't to never make mistakes again. That's impossible. The goal is to stop repeating the same ones and to start making new, more intelligent ones. That's what progress looks like. Okay, so this deep understanding of mistakes, it's the foundation for his entire practical approach. So let's get into it. How do we put all this stuff into practice? Well, Bhattacharya gives us a whole toolkit of rules you can actually use, drawn straight from his decades of experience. These are rules to help you build a more rational process. Now, check out this first set of rules. What jumps out at you? Almost none of this is about spreadsheets or stock charts. It's about psychology. It's about behavior. Character being more important than knowledge, because good judgment beats a fancy formula every time. Frugality, so you're not forced into making stupid decisions out of desperation. And that last point says it all. Getting rich is one thing, but staying rich, that requires a totally different mindset, one that's all about survival and humility.
And the second part of the toolkit, it's a bit more strategic, but you see the theme is still the same, survival. For instance, he talks about the difference between risk, which you can kind of measure, and true uncertainty, which is totally unknowable. That's a huge distinction. And that line, to finish first, you must first finish, that is just pure wisdom. You can't win the race if you crash on the first lap. So don't make reckless bets, and always, always know your margin of safety.
And here's maybe one of the most practical rules of thumb he gives. It's so simple, but man, is it powerful. Is an investment stressing you out? Is it literally keeping you up at night? Then the position is probably wrong for you, either because of what it is or how much you own. Your peace of mind is an actual indicator, so just sell it. It's a brilliant, simple rule.
So, we've gone through his journey, his philosophy on mistakes, his practical toolkit, and it all boils down to one final unifying idea. This really is the ultimate lesson from Sanjoy Bhattacharya's entire career.
And there it is again, exuberance and hubris. In plain English, getting way too excited and thinking you're a genius. He identifies these not just as, character flaws, but as the direct cause of the most catastrophic investment mistakes. The second you start thinking you can't lose is the second you're about to lose big.
So what's the big takeaway from all of this? It's that successful investing, over the long haul, isn't an IQ test, it's a temperament test. It's all about building a rational, repeatable process that protects you from your own worst enemy, yourself. It's about having the emotional discipline and the humility to know you don't have all the answers, and to just keep learning every single day.
And that leaves us with one final question to think about. When you make a decision, when you click that buy or sell button, just take a second and be honest with yourself. What's really in the driver's seat? Is it your calm, objective analysis? Or is it your ego, your fear of missing out, your desire to prove you were right all along? The answer to that question might be the most valuable thing you figure out all year.
All right, today we're going to dive into the mind of Vikas Khemani, the founder of Carnelian Asset Management. But look, this isn't going to be about hot stock tips or the latest market predictions. Nope, we're going deeper. We're going to explore how things like psychology, spirituality, and just plain humility have turned him into a true financial architect, someone who's always on the hunt for those hidden gems. So let's get into it. To really get what makes Khemani tick, we have to start with a little philosophy. He often quotes this poem from the 13th century poet Rumi, and it's just the perfect way to understand his mindset. It's all about humility, right? Accepting that some things are just, they're out of our hands. And that idea is absolutely central to how he invests. And that really gets to the heart of it. In a world completely obsessed with numbers and charts, Khemani is, he's more of a seeker than your typical investor. For him, investing isn't just a job you do to make money. It's a journey, a quest for wisdom. And real success, that comes from making clear, objective choices, unclouded by all the junk, all the personal biases we carry around. I mean, just take a look at his bio from X. This tells you so much more than any slick corporate profile ever could. You've got family, markets, and poker sitting right next to psychology, spirituality, and Vipassana meditation. It's pretty clear this isn't just some one-dimensional numbers guy. He's pulling from all these different fields, and that, right there, is fundamental to how he operates. And this quote, it just sums it all up, doesn't it? For Khemani, having a high EQ isn't some kind of soft skill. It's an absolutely critical tool for surviving and thriving in the chaos of the market. He's convinced that understanding yourself, your own biases, your fears, your ego, that's the first and most crucial step to making any sound financial decision. So you might be asking, where did this all come from? Well, like for a lot of us, it was hammered out on the anvil of his early life experiences. Let's kind of trace his journey from this tiny village all the way to the financial heart of India and see how these core beliefs really took shape. His story starts out in a small village in Rajasthan called Mandawa. From there, his family moved to Surat, which is a huge trading hub, and that's where he just soaked up all these stories about business legends. And then finally, he made his way to Bombay, what we now call Mumbai, and he brought with him this really powerful mindset that was forged way back in his youth. So when he was a young guy, he worked in his grandfather's clothes shop, and he'd just watch, day in and day out, as customers would haggle over every single rupee. That experience, it was huge. It taught him how to negotiate, for sure, but it also drilled this powerful instinct deep into his brain, always look for the bargain. And this right here, this chart shows you the whole evolution. That bargain hunter mindset he started with, it made him focus almost entirely on price. He was looking for cheap stuff, but sometimes he'd overlook the quality. Over time, though, he learned that super important lesson. price and value are not the same thing. The real goal isn't just finding something cheap, it's finding quality at a fair price. Now, this big shift in thinking, it didn't just happen overnight in a vacuum. It was fueled by him really digging into timeless wisdom and soaking up the insights from other great investors. This is where you really see the seeker and the investor start to become one and the same. You know, Kamini gives a lot of credit to the Bhagavad Gita for shaping his philosophy. And this one piece of advice, it's like his anchor in the stormy seas of the market. It reminds him to focus on his process, the research, the analysis, and to just accept that at the end of the day, he can't control the final result. It's an incredibly powerful way to deal with the anxiety and regret that can eat you alive in this business. So from the spiritual, we move to the super practical. He was also really influenced by the legendary investor Peter Lynch. This quote just hammers home a core principle for Kamini. You're not just buying a ticker symbol on a screen. You are buying a small piece of a real, living, breathing company. And thinking about it that way, well, it changes everything. And then, of course, there's Charlie Munger, the guy Warren Buffett called the architect of Berkshire Hathaway. Munger's whole thing about using mental models from different fields, psychology, physics, history, you name it, was a complete game changer for Kamini. It was like a confirmation of what he already believed deep down. To really understand the markets, you first have to understand people. Okay, this next part, this might just be the most important piece of his entire philosophy, his relationship with failure. For Kamini, mistakes aren't just something to feel bad about. They're the actual raw material for growth. They are, quite literally, the definition of experience. Think about that for a second. That's his definition of experience. It's so simple, but it's really profound. It's not about how many years you've been playing the game. It's about how many lessons you've actually learned from the times you messed up. This completely reframes failure from something shameful into something that's absolutely essential for getting better. And he doesn't just talk about it. He's got a crystal clear, practical process for what to do when you make a mistake. First up, you acknowledge it immediately. No ego, no denial. Second, you act fast. A lot of times, that means just selling and stopping the financial and emotional bleeding. Third, you reflect, figure out what went wrong. And finally, and this part is key, you move on. You can't let one bad decision paralyze you. So this leads to a pretty wild question, right? Can this whole process of handling mistakes actually make you money? It sounds kind of nuts, but Kamini has this amazing story that shows exactly how it can work. Let's talk about his investment in a company called KEI Industries. Soon after he bought in, the stock took a nosedive. By any definition, that's an initial mistake. But instead of panicking, he just followed his process. He went back, reevaluated the company, decided the fundamentals were still solid, and he held on with patience. And that mistake, it eventually turned into a massive winner for him. It's just a powerful reminder that sometimes resilience is way more important than perfect timing. Now, Kamini also makes this really vital distinction between two different kinds of errors. The first one is an error of commission. That's the obvious one. You buy a stock, it goes down, you lose money. It's direct and it hurts. But he argues that the second kind, the error of omission, is actually worse. That's when you don't buy a great company because you miss the opportunity. He's openly admitted that his own bias against expensive stocks made him pass on huge winners like Asian Paints back in 2004, and that mistake cost him a fortune in potential gains. So what causes these kinds of errors? Well, according to Kamini, the culprits are almost always psychological. It's a high ego that won't let you admit you're wrong. It's overconfidence that leads to lazy research. It's that fear of missing out, FOMO, that pushes you into trades you shouldn't be in. These things, he warns, are the absolute surest paths to failure. All right, so let's tie all these different threads together. Let's put it all into his final blueprint, a cohesive philosophy for navigating the incredible complexity of the market, and really, of life itself. For Kamini, if you boil everything down, the single most important factor is the quality of a company's management. And just look at the language he uses. It's almost poetic. He calls management the heartbeat of the business. Sure, valuations and business models matter, but to him, they're secondary to the human element, the competence, the integrity, and the sheer drive of the people running the show. And at the end of the day, this is what it all boils down to. Investing is a blend of science and art. The science part, reading a balance sheet, figuring out valuations, that can be taught in a classroom. But the art, judging the quality of a management team, having the gut instinct to see a situation differently from everyone else, that can only be cultivated through experience. And yes, through making a lot of mistakes. And so here we are right back where we started with the wisdom of the Gita. His ultimate advice is to just focus on your process, stick to your core principles, and try your best to stay detached from the daily noise and the wild swings of the market. He admits it's incredibly hard to do, but he believes it's the only way to keep your balance and clarity in a world that's defined by uncertainty. We'll leave you with a question that Kamani himself has spent a lot of time thinking about. The usefulness of a cup is in its emptiness. If a cup is only useful when it's empty, ready to be filled with something new, what do we need to empty from our own minds to make room for growth? Is it our ego, old biases, the fear of being wrong? That's a question for every one of us to think about.
You know, what if your biggest investment mistake has absolutely nothing to do with the stocks you pick? We're about to dive into the mind of one of India's most respected investors to challenge the single biggest assumption most of us have about our own financial decisions.
Just think about that for a second. We all do it, right? We obsess over the stock that got away or the one we sold way too early. But what if that entire way of looking at it is just wrong? What if the real mistake isn't the final score, but something much, much deeper in our process?
Well, we're going to find the answer by following the incredible 30-year journey and the hard-won wisdom of Devina Mehra, the founder of First Global. She's built her entire philosophy around this very question, and believe me, her story is going to change the way you think about success and failure.
So here's the game plan. We'll start with that feeling we all know, the fear of getting it wrong. Then we'll meet the crusader who spent her life fighting it. After that, we're going to completely redefine what a mistake even is. We'll dig into the lessons she learned the hard way, the system she built to fix the problem, and finally, we'll uncover the single biggest superpower you can develop as an investor.
Every single investor, I don't care if you're a total beginner or a seasoned pro, you know this feeling in your gut. It's that pressure to make the perfect call, to have a 100% batting average. As Devina Mehra found out, even her biggest institutional clients would laser focus on the one stock out of 10 that didn't work out. They'd always ask, why did this one fail? It's just an impossible standard, and it sets us all up for failure.
So how do you fight something like that? Well, you dedicate your life to building a better framework. Enter Devina Mehra. See, she hasn't just been a player in the market. She has spent over 3 decades taking it apart piece by piece, battling our own built-in biases and searching for a more rational way to invest.
And listen, she's got the credentials to back it up. We're talking about an IAM Ahmedabad gold medalist, a former Citi banker who went out on her own to start First Global way back in the early 90s. Her firm was the very first from Asia outside of Japan to become a member of the London Stock Exchange, and her thinking, it's deeply shaped by giants of behavioral economics like Daniel Kahneman, bringing this incredible intellectual rigor to the often messy world of finance.
Okay, so this brings us right to the heart of her philosophy, and maybe the most important idea in this entire explainer. She argues that before we can even begin to avoid mistakes, we have to completely rip up our old definition of them.
This is a total paradigm shift. I mean, a complete flip of the script. The old way, the way most of us think, is super simple. A mistake is a bad outcome. You bought a stock, it went down, you made a mistake. But Mehra's new way is completely different. A mistake, she says, is a bad process. The outcome? It doesn't matter nearly as much as whether the reason you made the call was solid in the first place. And get this. This is a real-life example from Devina herself, and it is stunning. She invested in a stock, it dropped 60%, then it skyrocketed, and she ended up making 40 times her money. A massive win, right? Nope. She calls it one of her biggest mistakes. Why? Because the reason the stock went up had absolutely nothing to do with her original analysis. She just got lucky. The process was wrong, even though the outcome was absolutely spectacular.
And that right there, that gets to the heart of it. You can make a fantastic, well-reasoned decision and still have a bad outcome just because of bad luck. And, as we just saw, you can make a terrible decision and get bailed out by pure, dumb luck. The only thing you can ever really control is the quality of your decision-making process. That has to be your North Star.
So you might be wondering, how does somebody even arrive at such a counterintuitive idea? Let me tell you, it's not from reading textbooks in some ivory tower. This is the kind of wisdom that was forged in the fire of real-world market chaos, over and over and over again.
I mean, you can look at charts all day long, but you don't really understand risk until you've lived through it. Devina Mehra has navigated every single major crisis of the last 3 decades. Each one of these events wasn't just a blip on a screen, it was a real-time,
gut-wrenching test of discipline, of process, and of your own psychological strength. This is what she calls the school of hard knocks.
Let's look at a classic case study, Sachem Computers. Back in its early days, Mehra actually met with the management team. She came away from that meeting with a huge red flag. Her process-driven analysis told her something was just off with the leadership, and she went and told her big institutional clients to be wary.
So what happened next? Of course, the stock went on an absolute tear for years. By that old definition, the one focused only on the outcome, her call looked like a massive, embarrassing mistake. She missed a huge bull run. Can you just imagine the pressure to abandon your process when the entire market is screaming that you're an idiot?
And then the inevitable happened. The whole house of cards collapsed in a massive fraud scandal. A scandal centered squarely on the management. Her initial process, the one that focused on the quality of leadership, was proven spectacularly correct. The market was wrong. Her process was right. It just took a little time for the outcome to finally catch up with reality.
This experience, and a ton of others just like it, led her to a really powerful conclusion. Human judgment is essential, it's critical, but it's also deeply flawed and full of bias. To be consistently successful, you need a system. You need to combine the best of human insight with the ice-cold discipline of a machine.
So here's how her human plus machine system actually works. First, the human expert, that's her, does the deep, foundational analysis to find good companies. Then, a machine system using tons of data on timing and momentum refines the exact entry and exit points. And this next part is crucial. The system enforces a rigid stop-loss. No human can override it because, as she says, human beings are just not good at acknowledging mistakes and taking losses. Finally, the entire process is codified to remove human emotion, mood, and bias, what Daniel Kahneman famously calls noise. And this is the key insight, straight from the world of behavioral economics. A machine doesn't have an ego. It doesn't get its feelings hurt. If the data says it's time to sell, it sells. Period. It has zero mental barrier to admitting a mistake, which means it can learn and adapt from wins and losses equally. It's the ultimate form of discipline.
Okay, so after all these decades of learning, what's the ultimate takeaway here? What is the single most powerful tool you can have in your arsenal as an investor? It's not some secret formula or a hot stock tip. It's a mindset.
First things first, we have to understand our own worst enemy, FOMO, the fear of missing out. It's that incredibly powerful pull you get when a trend is hot and it feels like everyone else is getting rich. It pushes us to commit what Mehra calls errors of commission. These are the mistakes we make by taking action, like jumping into a trend way too late, usually right before it all comes crashing down.
So to fight that FOMO, she loves this quote by Richard Branson. Opportunities are like buses. There is always another one coming along. It's such a powerful reminder that you don't have to catch every single trend. Missing one opportunity doesn't mean you'll miss them all. There will always be another chance, which means you can afford to be patient and just stick to your process.
And that brings us to the most crucial point of all. The real superpower isn't about being a genius. It's about humility. It is the ability to say to yourself with every single investment you make, you know what, I might be wrong about this. When you truly internalize that fact from the get-go, it changes everything. It means you're not emotionally attached. It means you can get out of a losing position quickly, logically, and without your ego getting in the way and costing you a fortune. Ultimately, her whole philosophy reframes investing as a loser's game. Now, that doesn't mean you're destined to lose, not at all. It means that, kind of like in amateur tennis, the winner isn't the person who hits the most spectacular shots. The winner is the person who makes the fewest unforced errors. Success comes from playing defense, from disciplined risk management and systematically avoiding the big mistakes that can completely wipe you out. So I'll leave you with this question. The next time one of your investments, or hey, any big decision in your life, doesn't go the way you planned, what's going to be your first reaction? Are you going to blame bad luck or the market or some other force outside your control? Or will you have the discipline to ignore the outcome for a second and honestly, truly audit the quality of the process that got you there in the first place? The answer to that question could be the most valuable investment you ever make.
So, what if I told you that one of the absolute sharpest fund managers out there describes himself as a failed photographer? Yeah. Today, we're diving deep into the mind of Manish Bhandari. He's a guy whose humble, kinda quiet persona hides a seriously powerful investment strategy. Let's unpack the secrets behind his incredible success. I mean, just take a look at his bio on X. You might find yourself scratching your head a little. Failed photographer, novice pianist, It's just so surprisingly self-deprecating for a guy at the absolute top of his game. It paints this picture of real humility, a sense of humor, but, and this is a big but, don't let that fool you. The reality of his performance? Well, that tells a very, very different story. Because this is the number that really matters, 45.7%. That's the return his fund, Valum Capital, delivered in fiscal year 24. Now, to put that into perspective for you, the benchmark index, it managed about 30%. So he didn't just beat the market, he absolutely crushed it. This is not the work of a novice anything.
And that brings us right to the heart of the matter, doesn't it? This is the central question for us today. How does someone with this disarming, humble public persona generate such mind-blowing results? What is the secret sauce behind his strategy? It's a fascinating puzzle, so let's break it down, piece by piece.
So, where does this incredible success actually come from? Well, to find the answer, we've got to go back, way back to the beginning, to a childhood hobby that, pretty unexpectedly, laid the entire groundwork for his investment philosophy. You see, long before he was trading shares, Manish was collecting coins. Now, it might seem like a simple hobby, right? But for him, it was basically a masterclass in value investing. It taught him how to look at an object that, most people would just see as pocket change and find its true underlying worth. And this right here, this is where the magic really happens. Think about the skills he learned as a coin collector, spotting those hidden gems, truly understanding their value, and then having the patience to wait. Those are the exact same skills he uses to dominate the stock market today. It's a classic value investing approach, It reminds me of legends like Dhirubhai Ambani, who saw massive opportunity where other people just saw spare change. It's all about seeing the silver content, not just the face value of the coin. This whole perspective forged his core philosophy on risk. For Manish, risk isn't some abstract number or market volatility. No, it's simply a lack of understanding. The more you educate yourself about a company, about an industry, a technology, the less risky it becomes. Fear is really just a symptom of the unknown. And the cure? Well, the cure is knowledge. Okay, so how does this philosophy translate into a real, concrete strategy? It's not just about finding good companies. It's about finding them at that perfect moment, right as they're about to take off. Bhandari calls this playing the acceleration game.
So what in the world is the acceleration phenomenon? Well, it's not just about a company growing. It's about the speed of that growth picking up. Think about it like this. It's the difference between a car that's just cruising along at 60 miles an hour and a car that is actively accelerating, slamming the pedal down from 60 to 100. That explosive moment is exactly what Bhandari is hunting for.
And he finds this acceleration by looking for very specific triggers. In the pharmaceutical world, for instance, it could be a breakthrough drug that completely changes the company's future. In manufacturing, it might be a huge investment in new factories, a big capital expenditure cycle. He's searching for that perfect storm, that moment where a company's capabilities, its expansion plans, and its money strategy all align to create a situation where 2 + 2 suddenly equals 22. But, and this is key, executing this strategy requires a really delicate balance. You have to have the discipline to stick to your framework, but you also need the flexibility to pivot when the facts on the ground change. It's like walking a tightrope. And that's exactly why Bhandari surrounds himself with a team that constantly challenges his ideas, making sure he never gets carried away by his own excitement or, blindsided by a new reality. Okay, now let's talk about something that most investors are terrified of, mistakes. For Bhandari, getting it wrong isn't just a possibility, it's a vital part of the process. He actually believes there's a massive upside to failure as long as you have the wisdom to learn from it. He basically splits errors into 2 camps. First, you've got errors of omission. That's when you see a great opportunity, but you hesitate, you fail to act, and you just watch it soar without you. The price you pay is underperformance. Then, there are errors of commission. This is when you pull the trigger on an investment and it turns out to be a total dud. The price there is a very real loss of capital. Both of them sting for sure, but both are also incredible teachers.
Just take his early investment in Rallis India, for example. The returns were pretty disappointing, but the lesson he learned was priceless. He realized he'd been way too focused on just the company itself, that bottom-up view, and had totally ignored the bigger economic picture. So years later, he applied that hard-won wisdom to an investment in PI Industries, and guess what? The results were phenomenal. A past mistake literally became the blueprint for a future triumph.
This all ties back to his favorite motto, Hara Wahi Jo Lada Nahi. It basically means those who have not fought are the ones who have lost. It's such a powerful reminder that you can't win if you're too afraid to even step into the ring. Being willing to risk a mistake is really the only path to victory. So, we have the framework, we've got the analysis, and we have this acceptance of mistakes. But there's one more layer to his process, something a little less tangible, something more intuitive. It's what you and I might call a sixth sense. So let me ask you, is superior investing just a cold, calculated game of crunching numbers on a spreadsheet? Or does that well-honed gut feeling, that intuition that you build over years of experience, does that play a deciding role? For Manish, there is absolutely no question that it does. And he's in some pretty amazing company here. From the head of HDFC Bank, talking about his organization having a sixth sense, to investing giants like Warren Buffett and Naval Ravikant, the world's top performers all trust their gut. Heck, even the U.S. Navy invests millions in honing the intuition of its sailors for those life-or-death situations. This isn't some mystical power. It's the result of years of hard-earned experience. For Manish, this sixth sense is his internal compass. It has helped him steer clear of danger, like a major media merger that looked great on paper but just felt off. He also sidestepped a digital company that later got all tangled up in regulatory problems. His intuition was whispering a warning that the data simply couldn't articulate. Okay, so we've got his strategy, his mindset, and his intuition. For this final section, let's tie it all together by looking at the man himself. Because in the end, who you are as a person, it deeply, deeply shapes how you invest. Manish has this really beautiful way of putting it. He believes an investment portfolio is essentially a self-portrait. Think about that. Every decision, what you buy, what you sell, and just as important, what you avoid. It all paints a picture of your personality, your biases, your values, and your history. And this is the beautiful duality of Manish Bhandari. On one hand, you have this intense, high-stakes world of finance. And on the other, you have a man who finds real joy in the simple things. Falafel, spending time with his daughters, and fumbling his way through a new piano piece. It's this grounding in his personal life that gives him the stability and the clear-headedness to navigate the absolute chaos of the markets. And he finds inspiration in the most amazing places. Take that recent Japanese plane rescue. It's incredible. 379 people were evacuated from a burning aircraft in just minutes, with 0 fatalities. How is that even possible? Stoicism, calm, and discipline. Bhandari points out that these are the exact same virtues you need to survive a financial crisis when it feels like everything around you is on fire. In the end, Manish Bhandari's success really comes down to one core thing. He is always looking forward. He learns from his mistakes, sure, but he never lets them hold him hostage. He sees failure not as some kind of endpoint, but as fuel for future growth. And that leaves all of us with a really powerful question to ask ourselves. What past mistake are you allowing to define your next decision? All right. Today, we're going to dive into the mind of a true legend of the Indian stock market, Raamdeo Agrawal. We're going to look past all the headlines about his massive returns and really get into the wisdom and the incredibly disciplined process of a man who's often called the Warren Buffett of India. His entire career is, well, it's basically a masterclass in how to think for the long term. Okay, let's kick things off with a quote that I think just perfectly captures his whole philosophy. It's funny, but it's also incredibly deep. In the world of investing, you're not going to be perfect. It's a fantasy. Real success isn't about trying to avoid every single mistake. It's about knowing they're going to happen and, more importantly, mastering how you react when they do. So here's our game plan for this explainer. We'll start with what it even means to be a sound investor. Then we'll trace his journey from a small town all the way to the top of the markets. We're going to unpack his legendary value migration strategy and that famous QGLP framework. And then we'll get into his masterclass on handling mistakes and finally take a look at the legacy he's built. Right, so let's start there. What is a sound investor? You know, in an industry that loves to talk about speculative genius and, let's be honest, some questionable tactics, Raamdeo Agrawal built his reputation on something way more durable, a solid, repeatable, and principled process. He showed a whole generation of investors that the real road to wealth isn't some high-stakes gamble. No, it's about doing the hard work, rigorous financial analysis, and really disciplined decision-making. His whole approach was so rooted in fundamentals that, of course, people started comparing him to the Oracle of Omaha, Warren Buffett himself. And this was the bedrock on which he and Motilal Oswal built their financial powerhouse.
So how did this all start? Every great investor has an origin story, and Agrawal's doesn't begin in some flashy trading room. It starts in a small town in Rajasthan with a mind that was, already kind of wired to understand how markets work. And when you look at this timeline, you can really see the path taking shape. It's just fascinating. While other kids were out there trading marbles, he was already thinking about the why, the dynamics behind their value. He then builds on that instinct, becomes a chartered accountant, to really get the keys to the financial kingdom. And when he finally gets into the markets, he's not afraid to mess up. He saw mistakes as just part of the tuition. And then bam, 1987, all those pieces click into place, and he and his partners start building what would become a financial empire, right from the ground up.
This brings us to the real engine, the secret sauce behind his legendary stock picking. It's so much more than just finding cheap stocks. He brought this powerful concept to India that gave him an almost predictive edge in the market. It's called value migration.
He got this idea from a book by Adrian Sliwatsky, and it's both incredibly simple and ridiculously powerful. See, value isn't static. It's always flowing, moving away from old, outdated business models and towards new ones that do a better job of giving customers what they actually want. The real genius is seeing that flow before it becomes a giant tidal wave. Here is a perfect example of this idea in action. Agrawal noticed this subtle but massive cultural shift happening in India. People were moving away from the purely practical, the get-the-job-done scooters. What did they want instead? They wanted motorcycles. These were becoming symbols of aspiration, of power, of status. So much so that they were becoming popular wedding gifts. Seeing that trend ahead of the curve led him to a huge win with his investment in Hero Honda. And he saw it happen again. He identified value migrating away from traditional labor-intensive human work and shifting toward the scalable, incredibly efficient world of software and technology. This kind of foresight made him an early backer of another iconic multi-bagger, Infosys. See, he wasn't just buying stocks. He was investing in these massive tectonic shifts in the whole economy.
One of the true marks of a master is the ability to make something complex feel simple. And Agrawal did exactly that. He distilled his entire investment philosophy down into a clear, memorable, and powerful four-letter framework that he's been so generous to share with the world, QGLP.
This is his four-step mantra, his playbook. First, find a high-quality business, one run by competent, ethical people. Second, make sure it has strong and sustainable growth ahead of it. Third, you've got to assess its longevity. Is this company built to last? Can it maintain its edge for years? And then and only then do you look at the price. You buy it at a price that's reasonable. It's this disciplined filter he uses to separate the real gems from all the noise in the market.
But this is where his wisdom really goes to a whole other level. Finding winners, that's only half the game. Like we heard in that opening quote, everybody makes mistakes. You could argue his most profound lessons aren't about his wins at all, but about how he has truly, truly mastered the art of being wrong.
He uses this brilliant analogy to explain it. He says, look, in a calm market, a mistake is like spilling coffee on your shirt. Yeah, it's annoying, but you'll be fine. But during a major crisis, a mistake can feel like you've just set the entire kitchen on fire. And yet, and this is the key point, those fiery, chaotic moments are often where the real opportunities are born. If you can stay rational and buy when everyone else is freaking out, you can pull diamonds right out of the ashes. It's all about context. And this isn't just some vague idea. He has a concrete process. When a stock starts going south, he doesn't sit around and hope. He corrects the error, and he does it fast. He's not sentimental. He reallocates that capital to put it back to work. It's an incredibly disciplined approach, making just a few key decisions a year, relying on hard data instead of gut feelings, and even using tools like meditation to keep his mind clear. But above all else, he is obsessed with avoiding that one catastrophic mistake, the kind of error that can knock you out of the game for good. So when we step back and look at the whole picture, what is the lasting impact of Raamdeo Agrawal? Well, it's pretty clear that his true legacy goes way beyond his own incredible portfolio or the success of his company. His greatest contribution has really been his willingness to just share the playbook. Through his annual wealth creation studies, his interviews, his speeches, he has demystified the art of value investing for so many people. He hasn't just played the game at the highest possible level, he's coached an entire generation of new players on how to play it the right way. And at the end of the day, he leaves us with this wonderfully practical piece of advice. The smartest lessons you'll ever learn in investing are usually the cheapest ones, the ones you learn by watching someone else mess up. It's about gaining all that wisdom without having to pay the steep, painful price of failure yourself.
And that brings us to our final question. We are so often focused on celebrating the big wins, right? The multi-bagger stocks. But maybe, just maybe, what Raamdeo Agrawal's career really teaches us is that the true mark of a master isn't just how they handle their victories, but how they navigate their losses, with resilience, with humility, and with a constant, burning desire to keep learning. Thanks for joining me for this explainer.
Have you ever heard of a market alchemist? It's a fascinating title, right? Well, today we're diving into the mind of the man who earned it, Atul Suri. He's a market strategist who believes investing is less about spreadsheets and more about, well, life itself. So let's spend some time together and figure out exactly what that means.
You know, to really get a feel for who Suri is, you have to look beyond the stock ticker. His friends have this great way of describing him. They say he's like that character in the movie who goes for a deep scuba dive, and when he comes back to the surface, the whole world looks different. Suddenly, everything is crystal clear. For Suri, the stock market is that deep ocean. It's vast, it's mysterious, sometimes it's downright scary, but it is absolutely full of hidden treasures if you just know how and where to look. And that really brings us to the core question, not just for him, but for every single one of us. What can the ocean actually teach us about investing? Now, I know what you might be thinking, that's a nice little metaphor. But trust me, this is way more than that. This idea is the absolute key to unlocking a powerful and surprisingly practical way to approach the markets.
All right, so before we get into the how, let's talk about the who. Who is Atul Suri, and what path did he walk to arrive at such a unique and, let's be honest, often contrarian view of the world?
Look at this career path. It's a who's who of Indian finance. He started back in '91, cutting his teeth with the legendary value investor Parag Parekh. Then, after founding his own firm to focus on derivatives, those complex financial tools, he made a massive move. In 2008, he went to work for the big bull himself, the late, great Rakesh Jhunjhunwala. This isn't just a CV. This is like learning to paint by sitting next to Michelangelo and Da Vinci. He was forged in the fire right alongside the giants of the game. But here's the kicker. As incredible as that resume is, it doesn't even tell half the story. Suri's real genius comes from outside the office. He runs marathons, which taught him everything about perseverance, about patience, about playing the long game. And that scuba diving, it's a constant reminder to explore, to look for those hidden gems that everyone else just swims right by. When you blend all that together, you get something special, a finely tuned intuition, and almost sixth sense for the subtle shifts in the market, way before they show up in the headlines.
So you take all of this, the lessons from market legends, the discipline from running marathons, the perspective from the bottom of the ocean, and it all boils down to one single radical idea that became the bedrock of his entire strategy. He calls it the 90% rule. And believe me, it has almost nothing to do with numbers.
And this is where he just flips the whole script. Suri is absolutely convinced that investing success is maybe 10% intellect. That's the part with the spreadsheets, the research, the analysis. The other 90%, the real game, it's all psychology. The battle isn't against the market. The battle is being fought right between your own two ears. And you know it's true, right? That feeling of pure panic when the market's crashing and your gut screams sell, or that insane FOMO when a stock is rocketing and you just have to jump in at the top. That's not your brain working, that's the 90% taking over.
So where does this incredibly powerful 90% come from? Well, Suri says it's from our psychological biases, a lot of which are baked into us when we were kids. These things shape who we are and they quietly dictate every single financial choice we make. Maybe you were taught to be incredibly frugal. Well, that might cause you to sell a winning stock way too early. Or maybe you were encouraged to be a big risk taker. That could make you hold on to a loser for way too long, just hoping it'll turn around. We're all basically running on old software, acting out these scripts without even knowing it.
Okay, so if investing is 90% psychology, and our own minds are basically rigged against us, then how in the world do you actually win? For Suri, the answer is surprisingly simple, but man, is it hard to do. You need an anchor, something to hold you steady when the emotional storms hit. You have to build and then totally, completely, and blindly trust your process.
Now, a huge part of trusting your process is completely changing how you think about failure. Just listen to this quote from Suri. Mistakes are an integral part of the learning curve. Think about that. In his world, a mistake isn't a failure. It's not a reason to beat yourself up. It's just data. It's the market giving you a clean, simple piece of feedback on how your process is working.
And this just nails his philosophy. It doesn't matter if the market is quiet and you make a small misstep, or if we're in the middle of a once-in-a-generation meltdown like during the pandemic. The size of the mistake might change, but the cure is always the same. Get back to the process. Stick to the rules you made for yourself when you were thinking clearly and rationally. You don't build the lifeboat in the middle of the hurricane.
Okay, so let's get practical. Let's say you have a process, a set of rules, but then you're at a party and your buddy tells you about some can't-miss stock tip. You get all excited, you throw your rules out the window, and you buy it. A week later, it's down 20%. What now? Well, here's the 3-step fix. Step 1, acknowledge it. Own it. Don't blame your friend, don't blame the market. Just admit, I broke my rules. Step 2, review it. Why did you do it? Was it greed? FOMO? Get honest about the emotional trigger. And step 3, recommit. Take the L on that stock, sell it, and get right back to following your process. Only this time, you're a little bit wiser. It's a constant cycle of learning.
Now, this next piece of the puzzle flows right out of that idea of process. Because if process is your map, then managing risk is your North Star. For Atul Siri, risk management is everything. It's more important than your smartest idea, more important than your highest conviction. It trumps all.
So let me ask you a question, and I want you to really think about it. What is the single biggest risk you face as an investor? Is it picking the wrong stock? Is it a sudden market crash? Or maybe missing out on the next big thing?
According to Atul Suri, the answer is brutally simple. The single greatest risk is financial ruin, going broke. It's the one thing you can never, ever come back from, which means your number one job as an investor isn't to get rich, it's to survive. It's just to stay in the game. Everything else comes second.
And that's why a tool like a stop-loss is completely non-negotiable in his book. A stop-loss is just an automatic sell order if a stock drops to a price you decide beforehand. But he's crystal clear, it is not a market prediction tool. It is a survival mechanism. It's your eject button. He's seen brilliant people get so attached to a stock, so convinced they're right, that they let their ego override their own rules. And that, he says, is how you get wiped out. For him, risk always beats conviction. No exceptions. Ever.
He also says there are really only two ways you can mess up. The first is an error of omission. That's when you make a mistake because you just didn't know something. The fix is simple. Stay humble, keep learning. But the second type, the error of commission, that's the dangerous one. That's when you know what the right thing to do is, but you let fear or greed grab the steering wheel and you do the exact opposite. And that right there is the battle you have to fight every single day.
And look at that, we've come full circle. We're right back where we started, the inner game. Because if you want to win in the market for the long haul, you first have to figure out how to win the war that's constantly raging inside your own head.
Suri has a perfect name for this struggle. He calls it the battle with the monkey mind. You know what that is. It's that chattering, impulsive, emotional part of your brain that wants what it wants, and it wants it now. It's always in a tug-of-war with your calm, logical, rational self. That conflict isn't always bad, but when it comes to investing, letting that monkey mind run wild is a recipe for disaster.
So how does he fight back? How does he tame his own monkey mind? With a whole toolkit of counterweights. It starts with that process we've talked so much about, but it goes way beyond that. He uses meditation to keep his mind clear. He relies on hard data and quantitative analysis to keep his emotions in check. He believes that living a simple, disciplined personal life is crucial. And he will tell you that physical and mental fitness are absolutely essential for anyone who wants to successfully manage money.
And here's an interesting side effect of this whole philosophy. He's extremely skeptical of making investment decisions by committee. Think about it. The world's greatest investors, Warren Buffett, his mentor, Rakesh Junjwala, they were individuals. He argues that the minute you put a decision in the hands of a committee, you invite ego, office politics, and groupthink into the room, and all that noise just drowns out the clarity you desperately need to succeed.
And so, we're going to end this with a final question. One that takes everything we've just talked about and puts it right back on you. We all track our profits and losses, right? We check our portfolios probably a little too often. But let me ask you this. Do you track your process? When you make a mistake, do you honestly analyze where you broke your own rules, and more importantly, why? Because according to the Market Alchemist, that is where the real gold is buried. Mastering the market in the end really just starts with mastering yourself.
You know, in the high-stakes world of investing, we all know mistakes aren't just possible, they're pretty much guaranteed. We spend so much time chasing that perfect strategy, right? The flawless trade.
But what if the real secret to success isn't avoiding mistakes, but actually embracing them? Today, we're going to dissect the anatomy of an investment mistake, using the hard-won lessons from a true master of the game. So, how does one of the best in the business completely reframe his relationship with failure? Let's find out.
I mean, this quote from veteran fund manager Sankar Narayan, it just perfectly captures the beautiful chaos of it all, doesn't it? It's not some neat science with clean formulas. No, it's messy, it's unpredictable, and a lot of the time it feels completely out of your control. This isn't about finding a perfect formula. It's about learning to see in the dark and, well, dance in the rain.
And this is the man himself. Sankar Narayan has spent decades wrangling with the stock market, and he'd be the first to tell you he's got the scars to prove it. His journey is a masterclass in turning these humbling defeats into a powerful, resilient strategy. And that journey, it began with a fundamental conflict between the world he was trained for and the world he chose to enter.
So, let's start right at the beginning. You'd think an engineering background would be a massive advantage in finance, right? I mean, all that math, logic, precision. Well, as it turns out, in the wild, unpredictable world of the market, it was actually more of an engineer's curse.
This just lays out the fundamental clash perfectly. An engineer's mind is trained to see the world as a series of inputs and predictable outputs. You know, if A happens, then B must follow. But the market doesn't care about your deterministic equations. It's an arena driven by fear, greed, euphoria, panic, all these human emotions that just refuse to fit neatly into a spreadsheet.
So armed with this engineering mindset, Narayan wades into the market with that kind of confidence only a novice can really have. He built these elaborate models, he analyzed years of performance data, he was looking for clean, repeatable patterns. And his first big misstep was right here, believing that the past was a perfect map for the future. He treated the market like a machine, totally failing to see that it's really a crowd. And as we all know, crowds are notoriously fickle.
And you can hear it in his own words. He was treating the market like an engineering problem. He thought if he just had enough data and the right formula, he could solve it and get the correct answer. But the market isn't a puzzle with one single elegant solution. It's a complex adaptive system that is constantly changing its own rules.
This misplaced confidence led him directly into what we can call the novice's folly. He started making these really aggressive bets, trying to force his small amount of capital to generate big returns fast. And the inevitable result? Well, as he bluntly put it, he found himself face first in a puddle of regret. But it was from that puddle that his real education in investing began. And that education, it taught him that not all mistakes are created equal. The lessons you learn when the seas are calm are very, very different from the ones you learn when a hurricane hits. Narayan learned to distinguish between the minor missteps and the truly existential threats, and that was a key evolution in his thinking.
So here's the crucial distinction. In calm, rising markets, Narayan says mistakes are like paper cuts. They're annoying, sure, and you might lose a little money on a bad stock pick, but they're rarely fatal to your entire portfolio. But a crisis? That's a whole different beast. Your focus has to zoom out from picking individual stocks to the much, much bigger picture, asset allocation. Your very survival depends on it.
And he put this theory into practice time and time again, learning from those early mistakes. Back in '99, when the world went mad for tech stocks with no profits, he saw these absurd valuations and completely avoided the dot-com crash by investing in boring, old economy sectors like cement and steel. Then, in 2008, as everyone else was panicking and selling everything, he saw the fear as a once-in-a-generation buying opportunity. And in 2020, amidst global lockdowns and terrifying uncertainty, he trusted his process and went overweight on equities. It just goes to show you, in a crisis, fortune really does favor the prepared mind.
But it wasn't just about navigating crises. He made some big mistakes in calm waters, too. He tells this painful story from the late 90s about becoming completely fixated on keeping his portfolio's price-to-earnings ratio low. Now, on paper, that sounds like a solid, value-based strategy. But in practice, during a roaring bull market, he ended up systematically selling his best-performing companies and buying cheap, low-quality ones, creating what he later called a junk portfolio.
The lesson was brutal but crystal clear. The market was in a distinct phase, but his strategy was stuck in the past. So the crucial point is adaptability. A rigid theory, no matter how smart it sounds in a textbook, can become a prison if you're not willing to see the reality playing out right in front of you.
Okay, so he learned to navigate the external market, but as any investor knows, probably the biggest battles, they're often internal. Narayan's journey wasn't just about mastering the market, it was about mastering himself.
From his early days as a stockbroker, Narayan noticed a simple but really powerful truth. The investors who refused to admit they were wrong, the ones who always had an excuse, they rarely improved. The single most important first step to growth, the very bedrock of learning, is just the humility to look in the mirror and say, yep, I messed up.
And that leads to a question every single investor has to ask themselves constantly. Am I holding on to this losing position out of sound conviction, based on a rational analysis of the facts? Or is this just my ego refusing to take the hit, refusing to admit I made a bad call? Naren stresses that the line between those two is incredibly fine, and your decisions have to be driven by ruthless rationality, not by pride.
It's fascinating how life outside the market can forge your resilience within it. Naren went through a deeply challenging period when his son's difficult diagnosis happened to coincide with extreme market turmoil. But surprisingly, this immense personal hardship didn't distract him. Actually, it forced a deeper, more profound focus, helping him refine his understanding of true risk and teaching him how to separate raw emotion from professional decisions in a way nothing else could have.
This resilience wasn't just some abstract mindset. He translated it into a practical system, a toolkit he designed to ensure he never made the same mistake twice. So here are his 3 core antidotes to error. First, meditation. And not for some abstract spiritual reason, but as a practical tool to quiet the noise, gain clarity, and fight those emotional biases of fear and greed. Second, dynamic checklists. For every new mistake, a new line item gets added. This isn't just a to-do list, it's a not-to-do list. It might include questions like, am I buying this because of FOMO? Have I ignored evidence that contradicts my theory? Is the valuation actually reasonable? And third, team collaboration. He champions this because he knows that no single person can see the whole picture. A trusted team is the best defense you have against your own blind spots and unchallenged assumptions.
So what does all of this, the engineering failures, the crisis navigation, those inner battles, the practical tools, what does it all add up to? Well, it all culminates in what Naren calls the path to mastery.
Naren's central philosophy is this: mistakes are not obstacles on the path to success. They are the path. They're the tuition you pay for a real-world education in the markets. But, and this is a huge but, there's one crucial condition. You only get credit for the lesson if you don't repeat the error. Mastery isn't about being perfect. It's about making sure every mistake is a new one.
Ultimately, this is the line that just sums it all up. The mistake itself isn't the story. The wins and the losses, they're going to come and go. What truly defines you as an investor, and maybe as a person, is what you do next. It's all about how you respond, what you learn, and how you grow from the fall. And this circles back perfectly to that powerful lesson from the 2008 crisis. In the middle of a storm, when your every instinct is screaming to hide and protect what you have, the biggest mistake of all can be inaction. Sometimes, in a world of panic, the greatest risk is simply not taking one.
And finally, a much-needed dose of perspective. Naren believes that if you can't look back at your blunders and have a bit of a laugh, you're probably missing the point. It's a powerful reminder that this is a human endeavor, full of flaws and follies, not some perfect science. A little humility goes a long, long way.
So we'll leave you with this final thought to reflect on. In this chaotic, unpredictable world of investing, we are all so terrified of being wrong. But what if the single greatest risk you could possibly take is trying so hard to be perfect that you never make a mistake at all? Because if you never fail, it probably means you never truly learned anything.
You know, when we talk about the titans of the Indian stock market, we usually focus on their big wins, right? Their killer strategies. But today's story is different. It's about a man whose entire investment philosophy was forged in fire, only after he had lost absolutely everything. Yeah, this is Vijay Kedia. To so many people, he's the man who mastered the bull market. He's a role model for investors, a familiar face you see on business TV all the time. His success is, well, it's legendary. But what if I told you the real story, the one that truly shaped him, isn't about the wins at all? It's about the soul-crushing losses that came way, way before them.
So let's dive in. We're talking about Vijay Kedia, a man who is, believe it or not, as famous for writing quirky songs about current events as he is for his incredible long-term investment strategies. A truly one-of-a-kind personality in the world of finance.
So, who is this guy, really? Well, he was born in Kolkata, and at just 19, he was thrown into the deep end of the investing world. After his father passed away, the massive responsibility of providing for his whole family fell right on his shoulders. He eventually founded Kedia Securities, but let me tell you, his journey to becoming this famous long-term investor was anything but a straight line.
And this is where the story really gets interesting. Because before he became a master, he had to learn what it felt like to fail. And not just fail, but to fail spectacularly.
His first attempts in the market? A complete disaster. He was just a teenager, but he was already buckling under the immense weight of his family's financial problems.
The losses just kept piling up. He talks about these sleepless nights, all of them crammed into one tiny little room, 6 family members, and the pressure was just becoming unbearable.
I mean, it got so bad that he hit a point of absolute grinding poverty. He remembers, so clearly it's painful, a time when he couldn't even afford to buy milk for his own child. Just think about that. And then came rock bottom. The family situation got so desperate that his own mother had to sell her jewelry just so they could get by. At that point, he had literally nothing left to lose.
But it was right there, at his absolute lowest point, that he learned his first and maybe his most important lesson. He had a choice. He could give up, or he could fight. And he chose to fight, not by making the same mistakes, but by really analyzing them. He finally understood that what he'd been doing wasn't investing at all. It was just gambling.
And that realization, that was the pivot. That was the moment he switched from dreaming about getting rich quick to actually building wealth through a smart, methodical process. And it changed absolutely everything. So in 1990, armed with everything he learned from his failures, he started all over again. And his new starting capital? A pretty modest 35,000 rupees. That was it. That's all he had to rebuild his entire life. And the results of this new approach? They were almost immediate. He put his money into Punjab tractors, and within a couple of years, his investment tripled. Then he zeroed in on ACC, buying shares at 300 rupees. Just a year later, they were worth 3,000. And this one trade shows you the power of his new strategy. He sold that stock and bought his very first house in Mumbai. And this just spells out the difference so perfectly. On one side, you have Sutta. That's pure gambling, right? It's based on the emotional dream of getting rich overnight. Kedia himself calls it injurious to your wealth. And for him, it led to ruin. And on the other side, you have true investing, based on solid fundamentals and a long-term plan. And that path, it didn't just bring him profits, it brought him stability, it brought him his first home. This quote, wow. Jab khone ke liye kuch nahi hota, to paane ke liye duniya hoti hai. It just perfectly captures the mindset that fueled his incredible comeback. It means when you have nothing left to lose, you have the entire world to gain. I mean, once you've hit rock bottom, the fear just disappears. It's replaced by this pure, unfiltered hunger to succeed. So, from all of these experiences, the good, the bad, and the ugly, he forged his own unique investment philosophy. And this isn't something you learn from a textbook, okay? This is a system built from hard-won, real-world wisdom. He breaks his whole decision-making process down into 3 really clear steps. First, it starts with intuition, that initial spark, that gut feeling you get about an opportunity. But, and this is so important, he doesn't stop there. Step 2 is all about data. He uses hard numbers and analysis to either prove or disprove his gut feeling. Because without data, intuition is just gambling. And finally, step 3 is validation. Whether the investment works out or not, the outcome itself becomes a lesson for the next time. Now, this is a core part of his philosophy. He believes, very strongly, that your mental capacity, your peace of mind, is way more important than your financial capacity. And why is that? Because, as he argues, it's a lot harder to recover from mental exhaustion than it is from any financial loss. And he has the perfect story to illustrate this point. An NRI friend of his was really pushing to partner with him on a big project. Kedia's sort of reluctantly offered a 25% stake, mostly just out of friendship. But then the friend passed the negotiations over to his CFO, who immediately started trying to haggle for a better deal. Kedia saw the future headaches coming a mile away and just retracted the offer completely. He chose his own mental peace over a complicated deal. And the result? He did the project alone, and it ended up making 100 times the profit he ever expected. You also gotta love his creativity with language. He actually coined the term Bhangar cap.
It's what he calls penny stocks that have no real value, no fundamentals. He compares them to Bersati main deck. You know, those frogs that come out and make a ton of noise when it's raining, like during a bull market, but they completely vanish the second the sun comes out. And this famous saying just perfectly sums up how he thinks about risk. He gets that risks are a part of life, and they're definitely a part of investing. Sure, a ship is safe in the harbor, but you're never going to discover anything new if you stay there. For him, the key isn't to avoid risk, but to take calculated ones you can afford to survive if things go south. So, after all these lessons learned through failure, through success, and through a lot of deep reflection, what's the ultimate takeaway? What is his core formula for finding those truly life-changing investments? Here it is, the Kedia multi-bagger mantra. And it's a beautifully simple and incredibly powerful formula. He looks for companies that are still small, but they're not brand new. They've got some experience under their belt. Crucially, they have to have massive aspirations, and they're playing in a market with just gigantic potential for growth. That right there is the sweet spot. You know, Vijay Kedia's entire life story is proof of this idea that every mistake has its take. Every mistake has a lesson. His journey shows us that the greatest wisdom doesn't come from avoiding failure, but from embracing it, analyzing it, and then building your future on top of those lessons. So it really leaves us with a question for you. What's the most valuable thing failure has ever taught you? You know, when we think of financial tech trailblazers, our minds usually go to the big hubs, right? Mumbai, Bangalore, maybe Delhi. But today, we're diving into the story of Ayush Mittal, a truly brilliant investor who, along with his brother, built one of India's most powerful financial tools, not from a bustling metropolis, but from the city of Lucknow. He's a guy known for his incredible depth of knowledge, but also for a really refreshing simplicity. But before we get into all his successes, I want you to think about something for a second. What is the single costliest investment mistake you've ever made? And I'm not just talking about money. I mean the cost to your confidence, your time, your peace of mind. Just hold that thought. Because Ayush Mittal's journey is defined just as much by his wins as it is by one colossal portfolio-crushing mistake and what he learned from it. So, here's our game plan. We'll start at the beginning, in Lucknow, with the creation of Screener. Then we'll get into his amazing track record in small-cap stocks. From there, we hit the turning point, the moment overconfidence led to disaster. After that, we'll look at how he turned that pain into wisdom, which shaped the mindset he has today. And finally, we'll pull out the key lessons for all of us for the long haul. Okay, let's start at the beginning. You can't really understand the investor without understanding where he came from. And this is the story of a trailblazer from Lucknow and the birth of a truly game-changing platform. Now, what's so fascinating is that Screener wasn't born in the financial district of Mumbai. It came out of Lucknow. Ayush and his brother Prayush built this incredibly powerful tool packed with data, customizable screens, alerts, the whole shebang. They essentially took institutional-grade information and handed it to the everyday retail investor. They leveled the playing field. And this quote right here, it just perfectly sums up his whole philosophy. People would ask him why Screener was so affordable, and his answer wasn't about a business model. It was about passion for the market. He truly believes that a lack of data should never, ever be the reason someone fails as an investor. It's all about empowerment. And that philosophy, that idea of empowerment, it wasn't just for his business. It completely shaped his own investing style. So let's look at how he built his reputation, which was all about focusing on small companies. This is his small cap success story. You know, his focus on small and mid-cap stocks came straight from his father, who was a sharp investor back in the 80s. And his dad gave him this fantastic metaphor. Finding the right small company isn't about slow, steady growth. It's like planting bamboo. For a long time, it looks like nothing is happening. And then, whoosh, it just shoots up with unbelievable speed. That's the kind of explosive potential he was looking for. And wow, did he put that idea to work. His track record is incredible. Just look at some of these early picks. These were companies he found when they were tiny, often in really boring, overlooked sectors. I mean, aquaculture, pipes and fittings. Not exactly headline-grabbing stuff. But he had the conviction to do the deep, hard research when nobody else was paying attention. And the payoff was just massive. This is what put him on the map. But here's the thing about success, especially when it goes on for a while. It can be a really dangerous drug. And that brings us to the absolute core of this story.
the moment when overconfidence strikes. This was his road of trials.
So picture this. From 2012 to 2017, the market, especially for small caps, was just on an absolute tear. It was a raging bull run. For 5 straight years, Ayush's strategy was firing on all cylinders. Every year, his success grew, and with it, so did his confidence. By 2017, he was at the absolute peak. He probably felt like he could do no wrong.
And that's exactly when the big mistakes crept in. He started taking shortcuts. He bought into Prakash Industries, even though there were corporate governance red flags, just because the numbers looked good. He gambled on a turnaround at Suzlon. These weren't the carefully calculated risks of his past. This was driven by pure emotion, by the fear of missing out. So, when the market finally turned, these stocks didn't just dip, they completely cratered. And what did he do? He averaged down, convinced he was right and the market was wrong. But they just kept falling. His judgment was totally frozen. It wasn't until these positions were down almost 70%, that he finally faced the music, sold, and took a massive, painful loss. And that was his moment of brutal clarity. The long bull market hadn't made him a genius. It had made him overconfident. He'd stopped doing the rigorous research that made him successful and started making emotional bets. He was anchored to the price he paid, just desperately hoping to break even, instead of objectively looking at the businesses, which were actually falling apart. Now, a hit like that could have ended his career. I mean, a lot of people would have just walked away. But for Ayush, this became the defining moment. This is where the story pivots. This is about turning mistakes into wisdom. So he built a practical toolkit to fight his own worst instincts. First, he forces himself to talk about his ideas, to actively seek out people who disagree with him. Second, he goes back to basics, poring over annual reports again. Third, and I love this, it's a little psychological trick from his dad, to break that mental inertia of holding a loser, he just sells a tiny bit, maybe 100 shares. It just gets the ball rolling. And finally, he reframes the whole thing. He focuses on switching ideas, moving that money into a better opportunity, which changes his mindset from loss to gain. This painful experience taught him something crucial: how to tell the difference between a real mistake and just plain old volatility. Take a look at this chart of Polymedicare, one of his biggest winners. You can see it had these terrifying drops of 50, even 70% along the way. An emotional investor would have sold in a panic. But Ayush had done the work. He knew the business was still strong, so he held on and turned what looked like a mistake into a massive success. And the story of Shivalik by Metal is an even more powerful example. He bought it in 2017. The stock did well, then some bad results came out, and it fell. Then the pandemic hit, and it just got obliterated, down nearly 80% from its peak. But here's the key. Right in the middle of the chaos, the company's management waived their own salaries. That single act of integrity gave Ayush all the conviction he needed to hold on. He focused on the people, not the stock price. And that stock, it went from a low of 25 rupees to over 1,000. Incredible. So let's zoom out from these individual stories and look at the overarching philosophy he developed. This is about the investor's mindset, the tools you absolutely need for what can be a really tough journey. Ayush makes this really crucial distinction between 2 types of mistakes. First, there are errors of commission. That's buying the wrong thing, like he did with Prakash Industries. These are the ones that really hurt you. They drain your mental energy, they wreck your confidence. These have to be avoided. But then there are errors of omission. That's missing a stock that goes up. His take on these? It's much easier to move on. Don't beat yourself up over it. The market is an ocean of opportunities. You just find the next one. He also has a fascinating way of thinking about risk. He encourages people to embrace it, but he defines it very specifically. He talks about perceived risk, which is really just all the stuff you don't know about an investment yet. So the goal isn't to be reckless. It's to reduce that perceived risk through hard work. You dig into the cash flows, you study the management, you even talk to their competitors. You work until the unknown becomes known. And to protect himself from his own worst biases, he lives by some hard and fast rules. Number 1, diversify. He never ever puts more than 3 to 5% of his capital into a single stock at cost. That way, if one idea turns out to be a complete dud, it won't sink the whole ship. And number 2, he has a clear list of red flags he just avoids, period. Companies with tons of debt, messy balance sheets, or management that's constantly asking for more cash.
So, this all brings us to our final section, the lessons for the long haul. Because at the end of the day, the goal isn't just to have a few good years, It's to evolve and to endure. This quote, for me, just captures his entire philosophy perfectly. The market isn't a game to be won. It's like an ocean. It's vast, it's powerful, and it's always changing. It offers endless opportunities, not just to make money, but to learn and to grow. The real goal is to just keep learning from your wins and, maybe more importantly, from your failures. So we'll end by turning the question back to you. Ayush now believes that the biggest mistake isn't always buying the wrong thing. It's being too afraid to explore new ideas. He learned to manage risk by turning that perceived risk into calculated knowledge. So think about that. What's the perceived risk in your own life or work that's holding you back? That thing that seems scary or complicated? Maybe it's just an unknown that's waiting for you to do the research. What's the next great opportunity you might be missing?
So, what happens when an investor who grew up in a world of scarcity gets dropped into a world of just overwhelming abundance? Well, today we're diving into the story of Gautam Trivedi, and let me tell you, his career is more than just a masterclass in finance. It's this incredible journey of unlearning old habits, blending a global view with deep Indian roots, and, learning from some seriously expensive mistakes along the way. All right, here's the roadmap for our journey. We're going to start with the old India mindset that he was basically programmed with from birth. Then we'll see that whole worldview get absolutely shattered when he has his capitalist awakening in America. After that, we'll actually join him on his famous Great India road trips. We'll get into the nitty-gritty of the painful mistakes that really shaped his philosophy, and then we'll unpack the playbook that led to his biggest wins. And finally, we'll see how he uses all that wisdom to navigate the tricky market we're all in today.
You know, to really understand an investor like Trivedi, you first have to understand the world that built him. And we're starting in a socialist India, a place where scarcity was the name of the game, and it basically hardwired an entire generation to think short-term. I want you to just picture a world where getting a car or even just a telephone line wasn't something you just went out and did. It was a huge, long-term dream. Now, this kind of scarcity, it didn't just affect your daily life, it shaped your ambition. The whole idea of building massive long-term wealth inside of India, it seemed kind of crazy, almost like a fantasy. The common wisdom was pretty simple. If you want to make it big, you got to go overseas. Betting big on India's own future just wasn't really a thing. And this number, wow, this just puts that whole missed perspective into focus, doesn't it? A 27-fold increase. That's not just a statistic, you know? That's the sound of a monumental opportunity just flying by. This is the real weight of that old, limited way of thinking, and it was the very first thing Trivedi had to completely unlearn to become the investor he is today. And that whole unlearning process, it really kicked off with one big decision. See, going to the United States for an MBA in the early 90s didn't just get him a piece of paper. It was like the spark that just detonated his entire view of the economic world.
Can you believe it? This simple question from a Pacific Bell telephone operator in LA back in '91 was the first real shock to his system. For Trivedi, coming from India, the very idea of having a choice for a phone company was just bizarre. The question didn't even compute at first.
So when the operator told him he had over 100 options, he was just stunned into silence. He said it took him a full minute to even process what she was saying. 100 choices versus the one government monopoly he was used to. This wasn't just some lesson in economics. It was a mind-blowing revelation about the power of competition and what happens when the consumer actually has a choice.
And this slide just lays it all out perfectly. On one side, you've got high costs, bad service, all dictated by one single entity. On the other, you have this vibrant marketplace where companies are literally fighting for your money, which pushes prices down and sparks all this innovation. For Trivedi, this wasn't just a phone call. It was a fundamental rewiring of how an economy could and probably should work.
His second big aha moment came in Las Vegas of all places. And it wasn't the casinos that got him. It was the sheer scale of private investment. I mean, just think about this comparison for a second. A single American city, built out in the desert, had nearly as many hotel rooms as the entire country of India at the time. That was a gut punch, a real lesson in the power of capital when you unleash it with that classic American philosophy of, if you build it, they will come. So, armed with this totally new capitalist worldview, Trivedi comes back to India. But he's smart. He knew he couldn't just copy and paste American ideas onto the Indian market. To really succeed, he had to get his hands dirty and understand the real India, the one that exists way outside the fancy boardrooms in Mumbai and Delhi. And this led to one of his most brilliant innovations.
He borrowed a line from Star Trek, and it became the mantra for his Great India road trips.
Now, the idea was pretty radical back then. Take these big-shot institutional investors, pull them out of their five-star hotels, and drive them into the Tier 2 and 3 towns and villages where the real economy lives and breathes.
Now, the goal wasn't to go out and discover some hot new company. It was to do what he called channel checks, basically on-the-ground reality checks on the big, well-known companies. Instead of just reading a report, they'd go ask, how are Maruti's cars actually selling in rural Bihar? Is Dabur really gaining market share in these small towns? He built a direct feedback loop from the people who were buying, selling, and using these products every single day.
And this kind of approach gave him insights you could never, ever get from a spreadsheet. In Patna, a distributor let them in on a shocking secret. Nearly half of all the branded goods being sold in that region were fakes. I mean, stop and think about the implications of that for a company's bottom line. That's a massive, critical piece of information that would never show up in a glossy annual report. This is the kind of stuff that gives you a real edge.
But here's the thing. Even with the best boots-on-the-ground research, investing is a mental game. And Trivedi is refreshingly honest about his own psychological blind spots and the huge opportunities they cost him.
This timeline here, it tells a really painful but important story. He was watching Indian Hotels, a company he knew inside and out, and he saw its stock just collapse during the pandemic. I mean, hotels were empty, travel was dead, and like a lot of us, he was just paralyzed by pessimism, waiting for it to get even cheaper, a price that, of course, never came.
And this quote, oh man, if you're an investor, you have felt this right in your gut. He missed that first big bounce, and then he made that classic mistake of thinking, it's already doubled, I'm too late. He got anchored to that old price, and it completely blinded him to the massive potential that was still ahead.
And the irony here is just devastating. He had personally hosted the company's CEO, heard the whole brilliant turnaround plan straight from the source, and he still didn't pull the trigger. Fear and his own blind spots cost him a 900% gain. That is a brutal but incredibly powerful lesson in fighting your own biases.
All right, so out of all these lessons, the wins and the painful losses, Trivedi put together a really clear playbook. It's for identifying great companies and, maybe even more importantly, having the guts and the conviction to hold on to them for the long haul.
His incredible success with Varun Beverages is the playbook in action. This wasn't a lucky bet. It was a thesis built on things you could actually see and verify. First, PepsiCo hands over 90% of its bottling operations to them. That's a huge vote of confidence. Then, they brilliantly piggybacked on the government's push for rural electrification. That allowed them to put over 1 million refrigerators in tiny towns and villages, which basically created a cold drink boom where there wasn't one before. And the result? A 23 times return.
Now, Trivedi is adamant that real due diligence goes way beyond the numbers on a page. You have to get a feel for the company's soul. Meet the founders in their office, not some fancy hotel. See if the place is frugal or flashy. What kind of car is the guy driving? And this is a big one. Is the next generation, the kids set to inherit the business, are they actually any good? These little details, they can tell you everything.
So how does all this hard-earned wisdom apply to the market right now? A market that a lot of people think is pretty expensive and maybe a little too driven by hype. Well, Trivedi has some very clear warnings for all of us.
He points to the spectacular crash of so many of these new-age tech IPOs as a collision between two totally different universes. See, in the private market, these companies were valued on metrics driven by hype, things like revenue multiples and growth at all costs. But the second they hit the public market, boom, they were judged by a completely different set of rules. Real profits, real cash flow. The two worlds slammed into each other, and unfortunately, it was the retail investors who paid the price.
And he leaves us with 3 final, timeless warnings that are especially important in a hot market. First, don't ever believe that a promoter with a shady past has suddenly found religion. Second, don't get sucked in by the hype of a new IPO without doing your own deep research. And third, never ever bet on a famous family name if the person next in line to run the show is clearly incompetent. A great last name can't save a bad business. In the end, Trivedi's whole journey gives us this powerful framework. You have to combine that on-the-ground research with a really disciplined mind. But his story leaves every one of us with the same essential question we have to answer for ourselves. In a world that is just overflowing with data and tempting stories, how do you develop the wisdom to know when you're looking at a true, once-in-a-decade opportunity and when you're just looking at a story that's too good to be true?
Hello and welcome.
You know, most of us, we spend our entire lives trying to avoid mistakes. I mean, it's just natural, right? Especially when there's money on the line. But what if I told you the real secret to success isn't about avoiding failure at all, but actually running right toward it? Today, we're going to dive deep into the philosophy of a really fascinating investor, Ravi Dharamsi. He sees mistakes not as liabilities, but as the very bedrock of growth. So let's explore this idea of how to fail forward. This quote right here is one of Ravi Dharamsi's favorites, and it really sets the stage for everything we're going to talk about. It completely flips the script, doesn't it? A mistake isn't some sign of weakness. It's proof. It's proof that you're actually in the game, that you're in the arena. It's the evidence that you're taking risks and trying to do something that actually matters. In any ambitious journey, failure, well, it's simply the price of admission. And let's be honest, there's probably no arena more high stakes than the financial markets. I mean, every single decision you make gets instant feedback, and a lot of the time, that feedback is just brutal. A wrong move can feel absolutely catastrophic. But it's in this exact pressure cooker of an environment that Dharamsi says mistakes can be transformed from these painful losses into your most valuable career-defining lessons. All right, so our first core idea here is simple, but it is so profound. You just have to accept that mistakes are going to happen. It's not a question of if, it's a question of when, and more importantly, how are you going to respond when they do? Now, Dharamsi gives us a really crucial insight here. He says mistakes are less about what you know, your education, and they're much more about how you act, your behavior. You could read every single book on investing, but when you're in the heat of the moment, it's those raw emotions, fear, greed, complacency. Those are the things that are going to trip you up. So the real goal isn't to build some kind of fortress against all errors. No way. The goal is to build a system for learning, to make sure that you never, ever make the same costly mistake twice. And this just brilliantly illustrates the point. A true legend, Peter Lynch, was aiming for a 60% success rate. 60%, think about that. That means being flat out wrong 4 out of every 10 times is baked right into a winning formula. This just completely normalizes imperfection. It gives you the freedom to take action, knowing that success isn't about being perfect. It's about making sure your wins are bigger than your losses and that you learn something from every single outcome. Okay, let's move on, because it turns out not all mistakes are created equal, not even close. The context, the environment you're in when you make them, well, that changes absolutely everything. This piece of wisdom comes from Dharamsi's own mentor, the late Rakesh Jhunjhunwala. And it's so important that it's literally displayed in his office. But why? Well, because it's a constant, glaring warning against the single most dangerous emotion for any investor, complacency. It's when everything's going great, when the market's flying high and you feel like a genius, that's exactly when you are at your most vulnerable. So let's kind of break this down. In the calm, bullish times, you get lazy. You start to ignore those little threats that are slowly creeping up. But in a crisis, the mistake is the total opposite. You panic, right along with everybody else. But here's the key. Look at the opportunity side of things. During a crisis, when fear is just rampant, that is when you get the chance to stand apart. That's when you can be brave when everyone else is fearful, and you can make the kinds of decisions that can literally define your entire career. Dharamsi learned this firsthand during the pandemic. He saw that moment of maximum pessimism for what it was, a moment of maximum opportunity. And his one big regret? Not investing even more heavily. Because he knows those moments of collective, irrational fear are incredibly rare. And if you have the courage and the capital to act, they are an investor's absolute best friend. Okay, so accepting mistakes is one thing, but how do you actively try to make better decisions? How do you avoid those really stupid, unforced errors? Well, this brings us to Dharamsi's practical playbook. First up is learning how to avoid this classic mental trap, the boiling frog syndrome. Just think of an overvalued stock. It hardly ever crashes overnight. No, the valuation just kind of creeps higher and higher. The warning signs slowly pile up, and you get comfortable. You just fail to see the growing danger until the water's boiling and it's way too late to jump out. Just recognizing this pattern is the essential first step to avoiding it. This next one is a brilliant tool for fighting that complacency and groupthink we were talking about. So picture this. 9 people on your team all agree on an investment. The 10th person's job, their only job, is to argue against it. Their entire mission is to find every flaw, every hidden risk, every single reason why the other 9 people are wrong.
It forces you to stress test your own ideas and find those blind spots before you put any serious money on the line. And really, the 10th man rule is just a form of this powerful mental model from Charlie Munger called inversion. Instead of asking, how can this idea succeed, you ask the opposite, how can this fail in the most spectacular way possible? By figuring out all the ways you could end up in disaster, you can then build a strategy to actively steer clear of them. It's about solving the problem by thinking about it completely backwards. And the playbook doesn't stop there. The Ramshi also uses a committee that regularly gets together to review past mistakes. He has a board of mentors for outside perspectives. He uses mindfulness practices like music and sports to stay centered. And he uses one of the most powerful tools of all, just reading widely, to learn from the costly mistakes of others so he doesn't have to pay that tuition himself. All right, let's talk about a really crucial distinction now. There are two fundamental ways to be wrong in this business, and understanding the difference between them is absolutely key to your long-term success. So, on one hand, you have an error of commission. It's pretty straightforward. You buy a stock and it goes to zero. You acted and you were wrong. It's a direct hit to your capital, and let's face it, a direct hit to your ego. But then there's the error of omission. This one's way more subtle. It's the failure to act on a great idea. Or maybe not acting boldly enough, like Dharamshi selling a huge winner like Bajaj Finance way too early. Now, while both of these are mistakes, the error of omission can actually be way more damaging mathematically. Why? Simple. Because a truly great investment has almost unlimited upside. And here's that mentor wisdom again, and it is pure gold. This is the absolute essence of risk management. You will be wrong. The key is to structure your decisions so that no single mistake, no single error of commission can ever take you out of the game. You absolutely have to live to fight another day. And this is one of the biggest behavioral traps that leads to those major errors. You fall in love with an investment, it's done well for you, it feels like it's part of your identity, you become emotionally attached. And then you stop seeing it objectively. Dharamshi warns that as you get more experienced, you realize you have to be dispassionate. Your job isn't to be loyal to a stock, your job is to be loyal to finding the next best opportunity, wherever that may be. Finally, we've got to talk about the foundation that all of this is built on. All these tools, all these concepts, they're driven by an essential mindset. This is the engine that makes the whole philosophy work. This quote from the cricket legend MS Dhoni, it just captures it perfectly. In investing, you can't control the market, you can't control the economy, you certainly can't control the outcome of any single decision. So what can you control? Your research, your analysis, your decision-making framework, your process. That, and only that, has to be your entire focus.
And this just builds on that exact same idea. Superior returns, they don't come from some secret formula or a hot tip. They come from consistently exercising superior judgment over a long period of time. So how do you develop that superior judgment? Well, by having a rock-solid process, and by learning from every single outcome, good and bad.
And it's so important to realize, this isn't some newfangled market theory. This is ancient wisdom. The Bhagavad Gita teaches this very same principle. Focus on your actions, your duty, your process, and detach yourself from the results. It's a really profound way to separate your ego from the chaotic randomness of short-term outcomes and just stay focused on what truly matters. This is Dharamshi's personal mantra, borrowed from Steve Jobs, and it is the perfect summary. Stay hungry means you never stop searching for the next opportunity. You never get complacent. And stay foolish means you always remain humble enough to know that you don't have all the answers. It means to always be curious and always be open to learning from your mistakes. So in the end, that's what it all comes down to. Every single mistake is a payment for a lesson. It's the tuition fee for the school of real-world experience. The question isn't whether you're going to pay it, because you will. The only real question is, what are you going to learn in return? So as you move forward, think about that. What's the next lesson you're willing to pay for to get where you want to go? Thanks for your time today. All right, today we're going to dive deep into the mind of a true titan of Indian investing, a guy they called the thinking investor, E.A. Sundara. We're going to unpack the core principles that made him a legend in a world that is just full of noise and hype, and really see what we can learn from his unique, almost philosophical approach to the market. You know, at the heart of everything Sundaram does is this beautifully simple idea he calls common sense investing. And here's the key. It's not just about trying to pick the next big winner. He believes that true lasting success comes just as much, if not more, from simply avoiding the wrong decisions. So, what gives him the credibility to make a claim like that? Well, it all comes down to his track record. It's a long history of making these bold and, more importantly, correct contrarian bets, of seeing where the market was headed when pretty much everyone else was looking in the complete opposite direction.
Okay, so take a look at this. This slide basically maps out a career built on disciplined skepticism. Back in 1999, at the absolute peak of the dot-com bubble, he was underweight on tech, which just means he was putting less money there than everyone else. Fast forward to 2007, right before the global financial crisis, he was cautious on infrastructure. In 2017, he stepped back from overheated mid-sized companies. And in 2018, he dodged the non-banking financial companies right before they hit a massive crisis. You see the trend here, right? This isn't just luck. It's a clear pattern.
So this pattern of seeing what others miss, of sidestepping disaster time and time again, it really makes you wonder, how did he pull it off? Well, Sundaram argues that the biggest roadblock for any investor isn't a lack of smarts or information. He says the real fight, it happens right inside our own heads, against two incredibly powerful forces.
And this quote right here, man, it just nails his entire philosophy. He stresses that, yeah, education is important for analyzing a company, but it's your temperament, your ability to control those emotions, that really separates the winners from the losers. At the end of the day, all the education in the world can't save you from your own bad temperament.
Let's break this down. So think about it. When the market's doing great and everything's calm, what trips us up? It's greed. It's that fear of missing out, that FOMO, that pushes us to chase the hype and buy stuff that's way overpriced. But then, bam, a crisis hits and the whole script just flips. Fear and panic completely take over, and that's when we sell everything, usually at the worst possible time. Just think back to the COVID-19 pandemic. I mean, it's a perfect case study. Before 2020, optimism was everywhere, and greed was just off the charts. Then in March of 2020, the crisis hit, and pure raw panic set in, leading to this massive sell-off right at the absolute bottom. And what happened next? Just as quickly as the market started to recover, greed came roaring back, with people scrambling to get back in, often just as mindlessly as they had scrambled to get out.
But here's the thing. This kind of wisdom, you don't learn it from a textbook. To really get his philosophy, we have to go back to where it all started. Because it wasn't born from success. Nope. It was forged in the fire of his own early failures, a period that became the bedrock for everything he would achieve later. So let's go back. Early in his career, we're talking 93 to 95, Sundaram himself admits he made a whole bunch of bad calls, driven by the exact same emotions he now warns us all about. And the consequences weren't just a blip, they dragged down his portfolio for years. It was a really painful, humbling lesson, and it forced him to face a hard truth. The problem wasn't the market, the problem was him.
But, recognizing you have a problem is always the first step. And in 1996, he made a decision that would change everything. He decided to bite the bullet, stop making excuses, and basically tear down and rebuild his entire investment approach from scratch. This was his turning point.
And this wasn't just some New Year's resolution. No, this was the beginning of a real disciplined process. Okay, so first up, he cleaned house. He ruthlessly sold off everything that wasn't working, all that deadwood. Second, he set up super strict, measurable rules for what makes a quality investment. No more guesswork. And third, he mastered the art of being patient, committing to only buy a great company when the price was truly right.
So that whole cleanup process, that's what grew into the disciplined philosophy he's famous for today. And at the heart of it was this huge mindset shift, something I think we can all learn from.
See, he had this breakthrough. He realized that trying to be the best all the time, chasing the highest returns, hitting every home run, it was actually a trap. It just leads to making risky, impulsive decisions. So he changed the goalposts. Instead of chasing perfection, he just focused on being consistently good. And that focus on the process, not the outcome, slashed his number of mistakes. And this new way of thinking led him to separate mistakes into two different buckets. On one hand, you have errors of omission. Think of this as missing the bus. You didn't get on, so you missed a great ride, but you didn't lose any of your money. On the other hand, you have errors of commission. This is like getting on the wrong bus, the one headed straight off a cliff. This is when you actively do something dumb and it causes real, permanent damage to your portfolio. For Sundaram, missing the bus is acceptable. Getting on the wrong one is not.
So the big question is, how do you avoid those portfolio-killing mistakes? Well, he defines a fatal mistake as anything that leads to a permanent loss of your money. And to avoid them, he stays away from four things: putting money into weak or dying businesses, backing companies that treat their smaller shareholders poorly, paying a crazy high price that's all built on hype, and this last one is a killer, getting all worked up about how much money your neighbor seems to be making. Which brings us to one of his most powerful practical rules, a simple guardrail to protect you from your own emotions. He just refuses to buy a stock when hype has blown its price way past its historical average. Why? Because he knows, deep down, that paying way too much for even the best company in the world is just a recipe for disaster. He will patiently wait, even if that means he only buys after a stock has already fallen a lot. So when you pull all of this together, when you connect all the dots, you get to the real heart of Sundar's philosophy. And it's not about making these flashy, genius-level moves. It's about the quiet, steady power of just keeping your head on straight. You know, it reminds me of what the great Warren Buffett always says. The market isn't this perfectly rational machine. In fact, it's often the irrationality. It's other people doing dumb things that creates the absolute best opportunities for those who can just keep their cool. And that right there, that's Syndrome's whole game plan in a nutshell. When the market is seized by crazy greed or paralyzing fear or just plain arrogance, prices get totally disconnected from reality. And that's when the calm, disciplined investor can step in and capitalize on the emotional mistakes that the crowd is making. And this number, 7 out of 10, it tells you everything you need to know about the humility in his approach. His goal isn't perfection. He knows being right 100% of the time is just pure luck. Instead, his goal is just to be right 7 times out of 10. And in his book, that is more than enough to get solid, sustainable returns over the long haul. And he's not just talking a big game. He backs it up with cold, hard discipline. Take his 3-year rule, for example. He'll give an investment about 3 years to prove that his initial idea was right. If the company's business hasn't gotten measurably better in that time, he doesn't hang on, hoping and praying. He chalks it up as a mistake, sells, and moves on. No drama. So if there's one single thing to take away from the incredible career of E.A. Sundaram, it's this: you don't need a genius-level IQ to be a successful investor. Sure, you need to understand business, but what it really demands is the right temperament. It's that ability to stay calm, to stay rational, when everyone else around you is completely losing their minds. And that really leaves us with one final big question to think about. After learning from a master like him, we have to ask ourselves, in this game of investing, are you really playing against the market? Or is the toughest opponent you'll ever face staring back at you in the mirror? All right, today we're going to dive deep into the mind of a true market veteran. We're going to explore a really powerful framework for dealing with something every single one of us faces as an investor: making mistakes. And we're not just talking about surviving them. We're talking about actually mastering them, using them to become a better, smarter investor. We're going to unpack a whole system for turning your errors into one of your greatest assets. Just think about that for a second. What's the one thing that really holds people back? For so many of us, it all boils down to one thing, doesn't it? The fear of being wrong, the fear of making a mistake and losing our hard-earned money. But what if I told you that the real problem isn't making mistakes, it's our entire relationship with being wrong that needs a complete overhaul? Our guide on this journey is Jyoti Jaypuria. Now with 37 years in the markets, this is a guy who's seen it all. He's been at the helm of research at places like DSP Merrill Lynch and ICICI. He's a seasoned pro who has built his entire career on a foundation of deep, almost scientific research and process, not on getting swept up in the latest market hype. He has this profound philosophy on mistakes, and we're going to break it all down. And it all starts here. This simple quote from the legend himself, Benjamin Graham, is really the cornerstone of Jaypuria's entire approach. It's all about a data-driven, process-oriented mindset. It's about ignoring the exciting, seductive story the market is trying to sell you and focusing on the cold, hard facts, the arithmetic, of a business's real value. This idea is the bedrock for everything else we're going to talk about. So, here's our roadmap for this explainer. First, we'll get into the inner game, the psychology behind why we make errors. Then, we'll learn how to tell the difference between a real mistake and just, market noise. After that, we'll look at a framework for classifying errors, a process to try and prevent them, and finally, we'll understand why, in the end, mistakes are an absolutely essential part of the game. So, let's start with our first stop, right inside our own heads.
Because according to Japoria, the vast majority of investment errors don't begin with a bad stock pick. Nope, they start with a psychological trigger. It's the inner game, our own mindset that we have to master first and foremost. And here they are, the two great emotional enemies of every investor, fear and greed. On one side, you have fear. It keeps people huddled in so-called safe assets, where inflation just silently eats away their wealth year after year. Then on the other side, you've got greed. It pushes people to chase hot tips and speculative bets without doing any real work, which, let's be honest, almost always ends in tears. They are just two sides of the same dangerous coin. Japoria actually has a name for this. He calls it the greed trap. It's that siren song of getting rich overnight. But he has a very clear warning. He says speed may thrill, but it also kills. The real path to building wealth isn't some mad dash. It's through consistent, well-researched growth, not by taking these huge, unnecessary risks based on a gut feeling. Okay, so let's say we get our emotions in check. How do we even know when we've actually made a mistake? Well, this brings us to a crucial distinction, one that really separates the pros from the amateurs. You have to understand the difference between the business and its stock price. They are absolutely not the same thing. Just look at this contrast. It says it all. Amateurs get obsessed with the stock ticker, right? How far is it from its 52-week high? What are people saying online? But Jaipurya argues that the pros, they learn to ignore all of that noise. They focus on the real engine of value. Is the management team actually executing its vision? Are they being smart about how they spend the company's money? What's the real on-the-ground condition of the business today? And this focus leads to very clear, unemotional rules for when to sell. Now notice something here. None of these rules have anything to do with the stock price. You sell if management's vision goes off the rails. You sell if they start making foolish acquisitions into unrelated businesses. You sell if your original reason for buying the thing, that long-term growth story, is just not valid anymore. The decision is driven by facts about the business, period, even if it means you have to take a loss. Okay, so building on that idea of having a process, Jaipurya doesn't just react to mistakes. He actually has a system for analyzing them. And this framework is what helps him tell the difference between just bad luck, a bad process, and, everything else in between. This little 2x2 matrix is incredibly powerful. Let's walk through it. Top left, a good process leads to a good outcome. That's the ideal, right? That's what we're all aiming for. Bottom right, a bad process leads to a bad outcome. Well, you kind of got what you deserved. But now look at the other two. A good process that leads to a bad outcome. That's disappointing, but you can live with it because you did the right things. The most dangerous box on this whole grid is the top right, the lucky break. And this is the key insight. Getting a great result from a bad process, maybe you just got lucky, the whole market ripped higher, whatever. That isn't a win. It's a huge warning sign. It's your process screaming at you that something is broken. Taking credit for pure luck is probably one of the fastest ways to lose a lot of money in the long run. This whole framework also completely expands our definition of what a mistake even is. You see, most investors only ever think about number 5 on this list, buying a stock that goes down. But Jaipurya forces us to consider all the other errors, the errors of omission. What about that great company you analyzed but never bought? Or that winning stock that you only bought a tiny position in? Or the multi-bagger you sold way too early for a tiny profit? These are all mistakes, and they all need to be analyzed and learned from. So, knowing what all these different mistakes look like, how do we build a system to catch them before they become catastrophic? Well, this leads us to Jaipurya's proactive 360-degree prevention process. It's all about creating an early warning system for your investments. So the 360-degree philosophy is really about understanding that a company doesn't exist in a bubble. Its health is completely tied to its suppliers, its customers, its competitors, its whole ecosystem. Think of it like this. The first signs of trouble, they don't usually appear in the quarterly earnings report. They appear like little ripples in a pond, way out on the periphery, long before they become a tidal wave that swamps the company. And we're not talking about some abstract theory here. This is about getting your hands dirty. It means digging into real-time data. It means getting on the phone and talking to the company's dealers. And just as importantly, talking to their competitors' dealers. Speaking with suppliers might give you the first hint that a company is struggling to pay its bills. It's this deep, on-the-ground research that gives you an information edge and helps you spot those fundamental shifts before anyone else. Okay, so after all this talk about process and prevention and systems, we arrive at what seems like a paradox.
The final and maybe most important piece of the puzzle is accepting that mistakes are and always will be a part of investing. You simply cannot eliminate them. Jay Puria warns us with this timeless quote. Every few years, especially when we're in a roaring bull market, people get swept up in this hubris and they start to believe that the old rules don't apply anymore, that this time it's different. And that is exactly when the costliest mistakes are made. History doesn't repeat itself perfectly, but human psychology is a constant. It never changes. This leads to a massive shift in perspective. Look, the goal of a great investor isn't to be right 100% of the time. That's a fool's errand. It's impossible. The goal is to structure your portfolio so that when you are right, you win big. And when you're wrong, you only lose a little. It's all about getting paid handsomely, getting asymmetric returns for the risks you thoughtfully decide to take. And this is exactly where his 3 U's philosophy comes into play. He actively hunts for stocks that are out of favor. They're undervalued, they're underowned by big institutions, and they're underperforming the market. Now, he acknowledges that the chance of being wrong on these names might be higher, but the potential reward, that massive asymmetry, is so huge that it justifies taking that calculated risk. And at the end of the day, why are mistakes just inevitable? Because as an investor, you are constantly forecasting the future, and you simply can't control all the variables. What are your company's competitors going to do next year? What new, crazy regulations will the government pass? You can analyze these things till you're blue in the face, but your actual direct control over them is basically zero. So ultimately, it all comes down to a constant process of learning from 2 main types of errors. First, you've got errors in your fundamental analysis. Did you miss a huge technological shift like the one that killed Kodak's film business? And second, you've got behavioral errors. Did you let your emotions, like greed during a market bubble, completely override your rational process? These are the 2 battlefronts where you have to constantly strive to improve.
So, we'll leave you with this final thought. The goal isn't perfection, it's resilience. The aim is to build an investment process that is tough enough not just to withstand your mistakes, but to actually learn from them and get stronger because of them. So, take a moment and really ask yourself, what is your process?
All right, today we are diving deep into the mind of Viraj Mehta. He's a really big deal in the Indian financial landscape, but what makes him so fascinating isn't just his incredible track record. It's his completely unconventional, almost revolutionary approach to getting things wrong. And look, let's be clear, Viraj Mehta is an absolute pro. As the managing director at Agrawal Capital, he has spent over a decade building a phenomenal investment portfolio. The man has earned serious respect for his razor-sharp analysis. He's exactly the kind of expert you'd want to learn from, watching his every move. But here's the twist, and it's a big one. If you were to ask him, Viraj, what's the real secret to your growth? What's at the core of your expertise? He won't point to his winning stocks. Nope. He'll tell you it comes from the investments that went sideways. That's right. He's one of those rare people who actually studies his own errors. He sees them not as something to be embarrassed about, but as the tuition you pay to get smarter in this game. His entire growth as an investor is tied directly to that relentless self-reflection. And that really gets to the heart of what we're talking about today. What practical, real-world wisdom can we actually pull from the missteps of a master? I think the answers might just change how you think about your own decisions, not just in finance, but in a lot of things. So let's rewind and start at the very beginning, because it turns out that some of our deepest, most ingrained financial biases are programmed into us long before we ever buy our first stock. Mehta is incredibly open about this. He says, look, coming from a middle-class background, he just wasn't used to seeing large sums of money sitting in an account. It felt unnatural. So what happened? His early investments did great, they took off, and his gut instinct was to sell, cash out, take the win. He sold his winning stocks way, way too early. It's just a classic example of how our past quietly shapes the decisions we make today. And that early mistake taught him one of the most powerful lessons in finance, the absolute magic of long-term compounding. You know, history shows us that markets, over the long haul, tend to go up. Patience is the superpower that lets your returns start generating their own returns. It's a game of time. Okay, so this is where it gets even more nuanced. Because Mehta argues that if you really want to learn from your mistakes, you have to first understand what kind of mistake you're actually making.
context is everything. He draws a really sharp line between mistakes made when the waters are calm and mistakes made in the middle of a storm. In calm markets, you've got the headspace to think, to reflect. But the real danger? Getting lazy, complacent. Then you have a crisis like COVID-19, where things are moving so fast, so unpredictably, that you're forced to make snap decisions. And if you panic and sell, there's often no time to get back in before the market just roars back to life.
And then he makes this other really crucial distinction. You've got errors of commission. Buying the wrong stock. Those are painful. They show up on your statement, bright red ink screaming at you. But then there are the errors of omission. The brilliant companies you analyzed, you understood, but you just failed to pull the trigger on. Those are invisible. They don't show up on any report. But man, they can be just as costly to your wealth in the long run.
All right, this is where it gets really good, because we're moving from just identifying mistakes to having a disciplined, step-by-step process for what to do about them. And Mehta's approach here is, well, it's methodical, almost surgical.
The key is he avoids knee-jerk reactions. When an investment isn't performing well, his first move is incredibly powerful. He's patient. He gives the company's management team at least 8 to 10 quarters, that's 2.5 years, to execute their strategy. And all through that time, he is constantly checking his original theory against the actual business results. And, this is critical, he leans on his team for due diligence to systematically remove his own emotions and biases from the equation. But here's the thing, even a fantastic process can't always save you from a bad start. He tells this story about his investment in TCPL Packaging as a cautionary tale. The company's management was great. They delivered strong performance, exactly what he'd hoped for. But his initial entry price was just too high. It was a bad call from day one, and even though the company did well, he eventually had to sell. It's such a powerful lesson. Your starting point matters a lot. And that story really gets at a fundamental truth in all of this. Your technical skill, your analysis, that's only half the battle. According to Mehta, the biggest, most important battlefield isn't the stock market. It's the 6 inches between your own ears. He identifies these 4 internal enemies that can sabotage even the smartest people. First, greed, which makes you chase hot trends without thinking. Then there's ego, which makes it impossible to admit you're wrong. Commitment bias, that little voice that tells you to stick with a losing idea just because you've already invested so much in it. And of course the big one, hubris, the dangerous belief that you just can't be wrong. So what's his solution? Radical emotional detachment. For Mehta, investing is not a game of passion or gut feelings. He sees it for what it truly is, an unemotional, math-based business. He doesn't take profits or losses personally because he knows there are a million variables completely outside his control. That mindset is his armor. It protects him from himself. And he actually turns this mindset into concrete rules for his team. First, all decisions are driven by hard data, financials, not whispers and rumors. Second, he sets firm timeframes, often 12 quarters, to judge a business. This prevents impatience from ruining a good idea. Third, he actively encourages his team to disagree with him, to argue, to pressure test every single thesis. And fourth, he manages hubris by admitting that it's just psychologically easier to sell and admit a mistake when the amount of money is smaller. And this is where it all comes together so brilliantly. You see how that disciplined mindset translates directly into a concrete, actionable playbook for managing the single most important factor in investing, risk. There's that number again, 12 quarters, 3 years. This isn't just a random number. It's the bedrock of his long-term philosophy. Think of it as a built-in circuit breaker against the kind of panic or euphoria that's driven by short-term market noise. But his number one tool for damage control, he calls it his magic formula. It's position sizing. It's simple, but it's genius. For his core holdings, the ideas he has the highest conviction in, he'll allocate a large chunk of the portfolio. For interesting thematic plays, a medium-sized chunk. But for the borderline cases, those intriguing but unproven ideas, he only allocates a tiny percentage. This way, even if one of those bets goes to zero, the damage to the overall portfolio is minimal. It's all about surviving your mistakes so you can invest another day. And what's interesting is that this same framework also leaves room for happy accidents. He talks about an investment in a company called Alkyl Amines Chemicals. He had some concerns about it, but then, out of nowhere, a sudden surge in demand for one of their products completely changed the game. The company's profits exploded. He calls it a lottery. It was an outcome he never saw coming, but he was in a position to benefit from it because his risk was managed from the very start. So let's bring all this home with what I think is the most powerful takeaway from Viraj Mehta's entire approach, not just to the markets, but maybe to life itself. It's this philosophy of constant, unending improvement. This is basically his creed. Mistakes aren't failures, they are the price of an education. The real goal isn't to be perfect. It's to make new mistakes, to just stop repeating the old ones. And he does that by keeping a detailed journal, by forcing that emotional detachment we talked about, and by constantly adapting a strategy based on what he learns from every single outcome, good or bad.
And so that really leaves us with a powerful question for ourselves. Mehta's entire career is proof of the power of learning from our errors. So take a second and think about your own decisions, whether it's in finance or just in life. What is the one old mistake that you will commit to not making again?
You know, when we talk about high-stakes investing, the word mistake is kind of treated like a dirty word, isn't it? It's something you're supposed to avoid at all costs, something to hide. But what if that's completely the wrong way to look at it? What if the real secret to winning isn't about avoiding mistakes, but about embracing them, deconstructing them, and building a system that actually thrives because of them? All right, let's really get into this. We're going to break down a super powerful philosophy on failure and success from a true master of the financial markets.
So, who's our guide for this? Meet Prashant Khemka. Now, he's the founder of Oak Capital Group, but he really cut his teeth at Goldman Sachs Asset Management. And we're not talking small potatoes here. This is a guy who co-chaired a $30 billion equity fund and grew the global emerging markets equity division from under $500 million to over $2.6 billion. His fund even got a rare AAA rating from Citywire. To put it simply, when Prashant Khemka talks about navigating the markets and dealing with mistakes, you definitely want to listen up.
And here's the game plan for our journey today. We're going to start by really dissecting what a mistake even is. Then, we'll get into how to learn from your losses, how to make sure no error is ever fatal, and how to get into the mindset of a master. And to wrap it all up, we'll see how this whole philosophy plays out in the real world.
So let's jump right in. The anatomy of a mistake. Because look, if you want to master something, you have to know exactly what it is you're dealing with. And in the world of investing, it is way more complicated than just seeing some red on your screen.
Now, I want you to really think about this for a second. When is a financial loss not actually a mistake? I know it sounds like a trick question, right? A loss is a loss. But getting this distinction is absolutely fundamental if you want to think like a top-tier investor.
And there it is, straight from the man himself. Not every financial loss is inherently a mistake. This is so important. I mean, think about it. You can have a brilliant, perfectly researched process that still leads to a loss just because of some crazy, unforeseen event. And on the flip side, you can make a totally boneheaded decision for all the wrong reasons and get lucky with a profit. The final outcome doesn't always tell you if the decision was good or bad. Khemka breaks down mistakes into two big categories. First, you've got your errors of commission. This is the one we all know and hate, the error of action. You actively put your money into something that turns out to be a dud. But then, there's the second, sneakier type, errors of omission. This is the error of inaction. It's that huge opportunity you looked at, analyzed, but decided to pass on, only to watch it go to the moon. Khemka argues this missed opportunity is just as much of an error, and honestly, sometimes it's even more costly.
Okay, now this is where it gets really interesting. The context of a decision can completely change how you should judge it. Khemka brings up the COVID-19 crisis back in March 2020. In normal times, you have plenty of data, you can make some reasonable forecasts, and you can sort of map out the likely outcomes. But in a full-blown crisis, forget about it. Time is crunched, information is a mess, and trying to forecast anything is, as he puts it, irrational. The probability curve just flattens out, which is a fancy way of saying a much, much wider range of things could happen. You just can't judge a decision made in that kind of chaos by the same rules you'd use on a calm Tuesday.
All right, so if we know what a mistake is, and just as importantly, what it isn't, how do we actually learn from it? This isn't about beating yourself up. It's about building a system, a process for reflection that turns every single error into fuel for your next big win. And this right here is Khemka's disciplined three-step process. It's super clear. First, you have to recognize the error. No ego, no excuses. Just admit there was an oversight. Maybe you missed a red flag in corporate governance, whatever it is. Second, exit the investment. Don't hang around hoping it'll turn around. Act fast to stop the bleeding. And third, and this is the most important part, reflect and analyze. This is where the magic happens. You have to dig deep and figure out why it happened so you don't make the same mistake twice.
Now get ready for an idea that might just break your brain a little.
Kemka talks about lucky mistakes. These are investments where your decision-making process was totally flawed, but because of pure luck or something changing in the market, you actually made money. He says you might even make more money from these lucky shots than from your well-thought-out plans. But, and this is the kicker, he still considers them mistakes. Why? Because the process was wrong, and you can't build a career on luck.
So this all boils down to one ultimate test. The one question you have to ask to separate a bad outcome from a truly bad decision. And it's this: knowing only what you knew at that time, would you make the same call again? If the answer is yes, well, then it wasn't really a mistake. It was a calculated risk that just didn't work out. But if the answer is no, that's where the lesson is. That's the mistake you need to take apart piece by piece.
Okay, which leads us to a really crucial point. Learning from your mistakes is one thing, but you have to be able to survive them first. I mean, no strategy on earth is going to work if one bad move can wipe you off the map entirely. So let's talk about how to avoid those fatal errors.
This is an incredibly confident thing to say, isn't it? In investing, there really are no mistakes that are truly fatal. And believe me, that isn't just bravado. It's the result of building a system specifically designed to make that statement true. He believes that if you set things up the right way, you can pretty much eliminate the risk of one of those catastrophic portfolio-ending disasters.
So how does he do it? It comes down to 3 simple but incredibly powerful rules. First, no leverage. He said he used it when he was younger, but now he avoids it like the plague. Without leverage, a stock can go way down, but it's really hard for it to go to absolute zero and wipe you out. Second, diversification. This is investing 101, but it's critical. Don't put all your eggs in one basket. And third, avoid overexposure. You spread your money across different industries and market segments so that if one area takes a nosedive, it doesn't sink your whole ship. These are the guardrails that let you survive to play another day.
All right, we've talked about the what and the how, and we've talked about survival. Now we get to the heart of it all, the mindset. This is the psychology, the inner game that an investor absolutely has to master to win in a world that's all about probabilities and uncertainty.
Get a load of this number, because it is both staggering and totally liberating. Kemka says that even the very best investors are flat out wrong 40 to 50% of the time. Just let that sink in for a second. Being a successful investor isn't about being right all the time. It's not even about being right most of the time. It's about accepting that you're going to be wrong, and wrong often, and building a strategy where your wins are just bigger than your losses. And to really drive this point home, Kemka uses this fantastic analogy that anyone can get, even if you've never watched a match in your life. He says, investing is a lot like the game of cricket.
Just look at this comparison. In cricket, even the absolute legends of the game make mistakes. They get bowled out, they misjudge a delivery. It's just an inevitable part of the sport. And it's the exact same thing for investors, with their bad calls and missed opportunities. So what separates the greats from everybody else? It isn't that they never mess up. It's that they make fewer mistakes, and, this is the most important part, they score a whole lot more runs in between those mistakes.
And that's the whole ball game, right there in that quote. It is all about maximizing your performance when things are going right. The goal isn't perfection. It's to generate such great returns on your wins that they more than make up for the inevitable losses.
Okay, for our final section, let's bring all this theory into the real world. Let's see how this entire philosophy of focusing on process, learning from what goes wrong, and thinking in probabilities translates into an actual market view. We're going to look at why Kemka is so bullish on India.
This is such a great case study. See, a lot of people look at a country's existing infrastructure, what Kemka calls the stock. But he argues that's not where you find the big returns. He points to Japan as an example. It has world-class infrastructure, no doubt, but it hasn't produced amazing returns because the pace of change is pretty slow. He believes real equity returns are driven by the direction and the speed of change. In India, the starting point might be lower, but the rate of improvement is just massive. He talks about the insane progress of Indian railways and the new Vande Bharat trains. Sure, they're not at Swiss standards yet, but that rapid improvement is what fuels the economy and drives the stock market.
And that really brings us to the ultimate lesson here. Success in investing, in business, in life is not about achieving some fantasy of perfection where you never make a wrong move. It's about building a robust system. A system that's designed to learn from your errors, a system that's structured to survive them, and a system that lets you absolutely crush it in the periods between them.
So, I'll leave you with this last thought.
Forget about the stock market for a minute and just think about your own work, your own life. After hearing how an elite performer thinks about failure, what is the one mistake in your past that maybe you need to look at again, not as a loss, but as a lesson that's just been waiting for you to learn from it?
All right, let's talk about someone really interesting today, an investment veteran named Sunil Singhania. Now, this is a guy with over 25 years of real-world, in-the-trenches market experience. He's seen it all, the crazy bull runs, the gut-wrenching crashes, and pretty much everything in between. So let's get into it and unpack the wisdom he's picked up on his journey to becoming a true market whisperer.
So who is this guy? Well, Sunil Singhania is the man behind Abacus, a major asset management firm. We're talking about someone who hasn't just survived, but has actually thrived through multiple, very different market cycles. His experience isn't just something he read in a book. It's been forged in the fire of real-world investing, managing public money and navigating the market's constant, and let's be honest, often chaotic changes.
You know, this quote right here, it gets right to the absolute heart of his philosophy. Investing is not about being perfect. It's not about never making a mistake, because that's impossible. He believes success is really just a numbers game. It's about making sure your wins happen more often and are bigger than your mistakes. It's all about managing your mistakes, not trying to avoid them altogether.
So to really get what makes him tick, here's how we're going to break it down. We'll start with his core wisdom, then dive into mastering your emotions, which is huge. Then we'll look at what he calls the 4 kinds of mistakes, building an investor's toolkit, seeing the bigger picture, and finally, tying it all together into your path to success.
Okay, let's start with what is, for most people, the biggest hurdle in investing, our own emotions. Singhania is convinced that this is where the most important battles are won or lost, way before you even glance at a stock chart.
And this right here is a fundamental truth. We all like to think we're these rational, logical beings, just crunching the numbers. But Singhania is crystal clear. Emotions like fear, greed, panic, and even overconfidence are always there, lurking in the background. Our brains are hardwired for fight or flight, not for calmly analyzing a balance sheet when the market is crashing. So the real skill isn't pretending those emotions don't exist, it's learning to recognize them and manage them.
So picture this. The market's going haywire. You basically have 2 paths you can take. On one side, you've got that knee-jerk, fear-driven reaction. We all know it, panic selling. And that almost always leads to a terrible call, locking in your losses at the absolute worst time. But on the other side is what Singhania calls disciplined inactivity. That's the very conscious and often incredibly difficult choice to just pause, stay calm, and let the storm blow over.
And this quote just nails it. I mean, think back to the big crises of the last 20 years. Those moments of absolute peak fear were often the moments of maximum opportunity for anyone who could keep their head. Your long-term performance isn't decided by the crisis itself, but by how you act during that crisis. It's all about your reaction, not the event.
Now this brings us to our next point, and it builds right on top of that emotional control. Singhania has this really sharp, nuanced way of looking at mistakes. And believe me, it goes way beyond just buying a stock that goes down.
So here they are. Okay, number 1 is the obvious one, right? The one we all feel in our gut. You buy a stock and it loses money. Simple. But check out the next 3, because this is where the real learning kicks in. Number 2 is the mistake of omission. You did all the homework, you really believed in the company, but fear or indecision just stopped you from pulling the trigger. Number 3, you were right, but you were too timid. You only put a tiny bit of money in and missed out on huge gains. And number 4, oh man, the one that haunts so many of us. You had a winner, but you sold it for a little profit, only to watch it go up 10 times higher after you got out.
The big insight here is that a mistake isn't just a visible loss in your portfolio statement. It's those invisible losses, the opportunities you completely missed or didn't fully take advantage of, that are often so much more costly in the long run. It's kind of like an iceberg. The small loss you can see on the surface is nothing compared to the massive opportunity cost hidden underneath. You have to analyze all 4 of these to get better.
I absolutely love this analogy. If you sell a great company just because the stock price doubled, you are making a decision based completely on the past. You're literally looking in the rearview mirror at the road you've already driven. The real question you should always be asking is, what lies ahead? Does the company still have room to grow? Is the story still good? That's looking through the windshield, where you're actually going.
Seriously, take a second and think about this. For a lot of us, the pain of that second, third, or fourth mistake, that missed opportunity, can stink even more than just a simple loss. Figuring out your own pattern is the very first step to fixing it.
Okay, so we get the psychology. We understand the real definition of a mistake, but what do we actually do about it in the real world? Well, that brings us to our third section, the practical toolkit that Singhania actually uses to navigate the markets.
So here's a look at his toolkit, and it's a mix of the mental and the practical. First, things like meditation to keep a calm mind. Second, using quantitative tools to review his portfolio objectively, taking the emotion out of it. Third, he's always plugged into what's happening with global events and valuations, because no market exists in a bubble. And finally, and this one is absolutely crucial, having the humility to just admit when you're wrong and cut your losses, instead of just clinging to a losing stock out of hope.
And he uses this brilliant and, let's be honest, painfully human analogy from the famous movie 3 Idiots. It perfectly captures the destructive power of jealousy in our lives. In investing, this is a huge trap. It makes you abandon your own well-thought-out strategy to go chase whatever stock your friend just bought or feel terrible that their pick did better than yours. It's a total emotional pitfall that just leads to bad decisions.
So, the core lesson from his toolkit is really this. Emotional detachment is a strength, it's a superpower. The ability to act rationally when everyone else around you is being driven by jealousy or greed or fear, well, that's what separates the good investors from the great ones over the long haul.
All right, let's zoom out a bit for our fourth section. Because investing doesn't happen in a vacuum, right? It's about understanding the world around you. And Singhania has this fantastic way of balancing the daily frustrations we all feel with the massive long-term opportunities.
This slide just captures this duality perfectly. On one hand, Singhania lives the daily frustrations of a city like Mumbai. The insane traffic, the pollution, the infrastructure problems. It's so easy to get bogged down by all that. But then, on the other hand, he sees explosive growth literally everywhere. Malls are packed, flights are sold out, hotels are full. The key is to see both sides and realize that the frustrations are often just the growing pains of that incredible growth.
And to navigate this complicated world, Singhania really aligns himself with timeless wisdom, like this famous quote from Warren Buffett. This shows you he isn't just chasing the latest trend. At his core, he's a value-conscious investor on the hunt for quality. He's willing to pay a fair price for a truly great company, but he absolutely avoids overpaying.
Now, this is such a critical distinction for every single investor to understand. You can find the best company in the world, amazing products, fantastic management, everything. But if you buy its stock at a ridiculously high price, when all that good news is already baked in, your returns are going to be terrible. The quality of the business and the quality of the investment are two completely different things.
So, we've gone through the psychology, the real definition of mistakes, the practical tools, and the big picture view. In our fifth and final section, let's pull it all together into an actionable plan, a real path to success.
So here it is. This is the path. First, accept that success is about managing your errors, not getting rid of them. Second, get a handle on your emotions. Third, expand your definition of a mistake to include all those missed opportunities. Fourth, figure out your own investment philosophy and then actually stick to it. And finally, and this is probably the most important one, learn from every single mistake you make, but make a promise to yourself to never repeat the same one twice.
And in the end, Singhania's advice is just beautifully simple. Don't overcomplicate things. Stay disciplined in your process, especially when it feels boring or hard. And stop trying to hit a home run with every single swing. The real goal is patience and achieving decent, consistent returns over a long time. That's how real, lasting wealth is actually built. So as we wrap this up, I want to leave you with this question. After hearing all of this wisdom, what is the single biggest lesson you can take away and apply to your own investing, starting right now? Whether it's redefining your mistakes or practicing that discipline in activity, just committing to one change. That's the first step on a much better path.
Let me ask you something. What if the biggest investment mistakes you ever make are the ones you can't even see? Today, we're going to tear down the playbook of K. Sarath Reddy, the founder of Unify Capital. This is a guy who's built an absolute empire, not by dodging mistakes, but by getting really, really good at making them and learning from them. It's a wild strategy, and honestly, it completely redefines what it means to win in the market. To really get inside Reddy's head, you have to start right here with this killer insight from Charlie Munger. What he's saying is, the really catastrophic mistakes, they're not the stocks you bought that went down. Nope. They're the ghosts in the machine, the absolute world beaters you looked at, you thought about, and then just never bought. This idea, this haunting concept of opportunity cost, it's not just a nice quote. It is the bedrock of Sarath Reddy's entire worldview.
So here's our game plan for today. We'll start with the art of the mistake itself. Then we'll get into this huge idea, missing winners versus picking losers. After that, we'll look at the unconventional playbook for success, dive deep into the psychology, the sweat, tears, and gut feel, and finally, we'll see how all this leads to finding glory in the most unlikely places.
All right, let's kick things off with Section 1, the art of the mistake. Look, to get Sarth Reddy's philosophy, you have to get his story. It's not your typical journey, and it pretty much laid the groundwork for the contrarian thinker he is today. I mean, just look at this. At 15 years old, 15, when most of us were reading comics, he's playing in IPOs. Then, a bit later, he sells a stock like Titan, not out of fear, but as a strategic move to fund his MBA. He was betting on himself. And maybe the most telling move of all, he sets up his firm in Chennai, deliberately getting away from the noise and the herd mentality of Mumbai. It's a classic Warren Buffett move, right? Go to Omaha to think for yourself. And the payoff for taking that road less traveled? A cool 25,000 crore in assets under management. This number isn't just for show, it's the proof in the pudding. This isn't just some nice theory. It's a battle-tested philosophy that has churned out incredible returns by being brave enough to look where nobody else is looking, at the opportunities everyone else is just too afraid to touch. Okay, now we are getting to the absolute heart of his philosophy. This is the part where he basically forces you to completely rethink what an investment mistake even is. And I promise you, it is not what you think. So why do we get this so wrong? Well, it's because of a little psychological gremlin called availability bias. See, our brains are wired to obsess over what's right in front of us. That stock in your portfolio that's bleeding red, you feel that. It's painful, it's visible, it's available. But what you don't see, what doesn't punch you in the gut every day, is the ghost of that stock you researched but walked away from, the one that then rocketed up 1,000%. This bias doesn't just nudge us, it completely hijacks our decision-making. And this chart just nails it. On the left, you've got your errors of commission. That's buying a dead. We all hate it. We all feel the sting. But Reddy says that's not the real enemy. The real danger, the thing that can truly wreck your long-term performance, is over on the right, errors of omission, missing the monster winner. These are the silent killers. And that's why at Unify, the most important postmortem question isn't, what did we buy that went wrong? It's, what phenomenal company were we blind to? What did we miss? That, my friends, is a total paradigm shift. But let's add a really critical piece of nuance here. This isn't about kicking yourself for not having a crystal ball. An error of omission isn't just any stock that went up without you. No, it only counts as a true mistake if the facts were out there, if it was in your circle of competence, and you still failed to pull the trigger. It's a failure of conviction and process, not a failure of prophecy. Okay, so you're buying into this idea. It makes sense, but how do you actually build a whole investment firm around it? Let's get tactical now and look at the actual playbook, the blueprint for winning in a way that, frankly, scares the heck out of most people. This quote right here gets to the absolute core of the human condition in markets. Think about it. There's this massive, invisible pressure to just do what everyone else is doing. Why? Because it's safe. If you follow the herd and you're wrong, well, everyone was wrong. No big deal. But if you step out, you make that lonely, unconventional bet, and it goes south, you look like a fool. And that fear, the fear of looking stupid, is what keeps most people locked in mediocrity. So to combat that herd instinct, you have to deliberately engineer a culture that fights it. You make mistakes normal. They're just data points, not moral failings. You mandate brutal honesty and open debate. When you review a mistake, it's not a trial. There's no pointing fingers. And this next one is key. The team owns every single position, not one person. That strips the ego right out of it. The only real sin in this kind of culture? Making the same mistake twice. And what happens when they do make one of those errors of commission? When they buy a loser? The response is like a SWAT team raid. The philosophy is blunt. Chop a limb to save a life. You are relentlessly retesting your thesis. The second a red flag pops up, you're on it. And then you act fast. The decision to sell, hold, or even double down is made with lightning speed. Hesitation is your enemy. You take the hit, learn the lesson, and get that money back to work somewhere else immediately. But look, having a brilliant process is only half of it. Investing isn't a math problem. It's a messy, deeply psychological human endeavor. So let's get into the inner game, the stuff that happens inside your own head that really makes or breaks you as an investor. This is such a deep point.
All those things that made you who you are, your upbringing, your first boss, your early wins and losses, they aren't just memories. They get hardwired into your brain. They literally become your instincts, and they are quietly pulling the levers on your decisions, whether you like it or not. And here's a truth nobody likes to hear. That thing we call experience, it's not just about time in the market. It's scar tissue. Real judgment is forged in the fire of genuine pain, the pain of losing money you couldn't afford to lose, of being wrong when you were so sure you were right. It's those gut-wrenching moments that teach you humility and force you to master your own emotions.
Okay, let's make this real. Let's run a quick simulation. Imagine this. You put your money into what you thought was a fantastic company. Now it's a total disaster. Profits have fallen off a cliff. The star CEO just walked out. The stock is in a nosedive. And some new person you never heard of is taking over right before the next earnings call. Your stomach is in knots.
The stock is down 20%. Right now, what is your gut telling you to do? Hit the sell button and just make the pain stop? Freeze up and do nothing? Or do you see blood in the streets and start buying more? Be honest with yourself. What's your immediate emotional reaction?
Well, the trick is that the right answer has nothing to do with buying, selling, or holding. The right answer is about the process you follow in that moment of crisis. And here's Sarat's playbook. Rule 1. Nobody goes public. The second you plant a flag, your ego won't let you retreat. Rule 2. All internal and external notes become purely factual. No adjectives like great or terrible, just the data. And Rule 3. The chief investment officer makes the final call. That shields the analyst from the pressure and lets them think clearly. The whole system is a machine designed to surgically remove emotion and ego when the stakes are highest. Now, just when you think it's all about cold, hard process, he adds this fascinating final layer, intuition. He talks about George Soros, who would famously sell a position when his back literally started to hurt. Now, that's not fear or greed. That's what he calls the second brain. It's thousands of hours of experience and pattern recognition all being distilled into a single physical feeling that something just isn't right. And that kind of professional instinct, he says, you ignore at your peril. So let's bring it all home. We've talked about embracing mistakes, about mastering our own psychology, and even trusting our gut. How does all of that come together into one big final vision for how to see the world as an investor? This quote, for me, is the perfect summary of everything. We all want our journey to be a perfectly paved superhighway, right? But the reality is, the road to success is full of potholes. It's messy and it's bumpy. Now, the average person spends all their energy trying to swerve around those potholes, terrified of the damage. But the great investor, they understand the potholes are just part of the road. And sometimes, the best opportunities are hiding right at the bottom of them. And this is that idea on a grand scale. A pessimist looks at a place like India and all they see are the potholes, right? The challenges, the bureaucracy, all the things that are wrong. But an investor with Sarath's mindset looks at that exact same picture and sees something totally different. They see every single one of those problems as a massive, multi-billion-dollar opportunity waiting to be solved. They see a superhighway being built, one pothole at a time. It's the ultimate proof that what you see depends entirely on how you choose to look. So I'll just leave you with this one last thing to think about, not just for your portfolio, but for your life. What is the biggest winner you've missed? What amazing opportunity, a job, a relationship, a big move, did you let slip by, not because it was a bad idea, but simply because you were so afraid of the very visible, very painful possibility of failing? It's a heavy question, but it's one worth asking.
You know, in the world of high finance, you see a lot of leaders build successful companies. But it's rare to see someone build a true legacy. Well, Amisha Vora did both. She took an 80-year-old firm and absolutely rocketed it into the modern age. So what's her secret? In this explainer, we're going to break down the playbook of this truly limitless, data-driven leader.
All right, let's just start with a number that barely sounds real. 36 times. Between 2002 and 2008, Amisha Vora grabbed the reins of Prabhades Lillather's institutional business and grew it by a factor of 36. And no, that is not a typo. That's the kind of insane growth that completely changes the game and sets the stage for a legendary career.
And believe me, this was no one-hit wonder. When she shifted her focus to lead the retail broking side of the business in 2012, she did it again, delivering 10x growth over the next decade. This just proves her strategies aren't just powerful, they're incredibly versatile. She can scale completely different parts of the financial world.
But, you know, her impact goes way beyond just the numbers on a spreadsheet. This quote
I think, really gets to the heart of her philosophy. It's not just about leading, it's about stewardship. It's this deep sense of responsibility for the legacy and the future of the firm she's guiding. That speaks volumes about her vision.
Okay, so here's how we're going to unpack Amisha Vora's playbook. We'll start with her incredible journey, then dive into her philosophy on the market. We'll look at the inner biases she says we all have to fight, unpack her actual framework for making rational choices, and finally, we'll pull out the lessons that go way beyond just money.
First up, a limitless leader. Let's really trace the path that made Amisha Vora an icon. It's a journey defined by some incredibly bold moves and just a relentless drive for excellence.
This timeline, it really tells a powerful story. I mean, she starts out as an analyst, she joins PL in 2000, and just 6 years later, she's already a co-owner. But the end game, that was even bigger. In 2022, she acquires a controlling 96% stake, taking full command of an 80-year-old institution. That is a masterclass in playing the long game.
And of course, success like this does not go unnoticed. Her awards range from Most Iconic Woman of the Year all the way to leadership awards from the United Nations. Look, these aren't just trophies on a shelf. They are a clear validation from her peers and from global institutions that her impact on the industry has been profound.
This image of the bull, it perfectly captures the world she dominates. The bull is all about raw strength and optimism. But Vora's whole success story is built on knowing that strength by itself isn't enough. It has to be guided by discipline and by data, and that leads us straight into her core philosophy.
So now we get to the real core of her playbook. Vora makes a pretty bold argument. Success in the market isn't actually about being the smartest person in the room. It's a psychological game. She believes your ability to manage your emotions, your EQ, is way more important than raw intelligence, your IQ.
And in her own words, she just cuts right to the chase. The entire market, with all its crazy charts and complex algorithms, it all boils down to two primal human emotions, greed and fear. Every single boom and every single bust is driven by the collective swing between those two forces. If you can master them, you master the game.
And this slide just lays out that conflict perfectly. When times are good and the market's calm, greed takes over. We get complacent, we start chasing risky stocks. But then, when a crisis hits, fear slams on the brakes. We panic sell right at the bottom, and we miss the huge opportunities that are always born out of chaos.
So what's the solution? What's the antidote? According to Vora, it's this incredibly simple but unbelievably difficult principle: stay calm and stay rational. It's about building a mental fortress that can withstand the emotional storms of both bull and bear markets, so you can make disciplined decisions when everyone else is, frankly, losing their minds. Now, to build that rational mindset, you first have to understand the enemy. And as Vora teaches us, the enemy is usually looking back at us in the mirror. So let's talk about conquering that inner investor by digging into the behavioral biases that sabotage our own success.
First on the list is loss aversion. It's a weird quirk of our brains. The pain of losing, say, $1,000 feels way, way worse than the joy of gaining that same $1,000. This imbalance is what fuels panic. When the market drops, that intense pain of seeing red on your screen triggers this primal urge to just make it stop, which is why so many people sell at the absolute worst time.
Next up is cognitive dissonance. This is all about our ego getting in the way. So we believe we're smart investors, right? But our stock is tanking. Instead of just admitting we made a mistake, our brain creates this mental conflict. And to solve it, we cling to that losing stock, hoping it'll come back, just so we don't have to face the psychological pain of being wrong.
And finally, there's anchoring. This is when we get stuck on one piece of information, usually the price we first bought a stock at. We might refuse to sell it because it's below what we paid, even if the company's fundamentals have completely fallen apart. We're anchored to the past, and it makes us totally unable to make a rational choice based on the future.
Okay, so we've identified the emotional forces and the psychological traps that are all working against us. Now, let's open up Amisha Vora's personal toolkit, the actual strategies and frameworks she uses to stay disciplined and make rational, data-driven decisions.
And what's so fascinating here is that her framework doesn't start with spreadsheets or financial models. It starts with personal well-being. She says it's all about physical fitness for mental clarity, emotional fitness through things like meditation to handle stress, and conscious fitness to sharpen your focus. A clear mind, she says, is the single most powerful tool an investor can have.
And check out her systematic approach for what to do when you make a mistake. It's a super clear, 3-step process. First, you observe when something's not going the way you expected. Second, you analyze it deeply. Is this a fundamental problem with the company or just market noise? And finally, you decide. Either cut your losses and get out or hold firm. It's a structured response, not an emotional reaction.
At the very center of her thinking is this idea she calls the delta principle. You know, delta is the symbol for change. So instead of asking, is this a good company? She's always asking, what has changed? By focusing on these little incremental or delta changes in risk and opportunity, she stays nimble. It keeps her from getting anchored to an old story and makes sure every decision is based on what's happening right now.
So in this final section, we're going to see how Amisha Vora's philosophy isn't just for managing a stock portfolio. These principles are universal. They offer some pretty profound lessons on leadership, on personal growth, and on building a legacy that lasts.
She really lives by 4 core principles. 1. Every single mistake is a lesson. 2. The past is for learning, not for living in. 3. Problems aren't roadblocks, they are actually opportunities. And 4. The best decisions always come from the collective wisdom of a diverse team. You can see how these rules apply just as well to running a company as they do to just navigating your own life.
This is her favorite quote, and it just beautifully sums up her entire philosophy. It's all about the power of paying attention to the details, of consistent effort, and understanding that real excellence is built one brick at a time, by relentlessly getting the small things right, day after day. And that brings us to the final and maybe the most crucial takeaway. Vora teaches us that mistakes aren't just inevitable, they are absolutely essential for growth. The most successful people in finance and in life don't avoid errors. They embrace them as the best teachers they'll ever have. So the question I want to leave you with is this: what are you going to learn from your next one?
Today, we're going to get inside the head of one of India's most respected investors, Madhusudan Kela. We are going to unpack the philosophy of a man who over 30 years has really found some profound wisdom in the markets. And it's not just about investing, it's about life.
You know, everyone in the business calls him Madhu. And he's not just some strategic genius who's out of reach. He's a mentor who can break down really complex ideas like you're just chatting over a cup of tea. He's earned this huge amount of respect, not just for the money he's made, but for his wise, practical, and honestly, remarkably simple way of looking at the market.
And this is pure Kela. Right out of the gate, he just cuts through all the jargon with his brutally honest observation. This quote really sets the stage for everything he believes. In the market, it's not just about having capital. It's about having wisdom. And that wisdom, well, it's often earned the hard way.
So here's how we're going to break it all down in this explainer. We'll start with his backstory, then we'll look at the man behind the money. After that, we'll dive into his fascinating ideas on making mistakes, check out his practical strategies, and we'll wrap up with his biggest, most timeless lessons.
Okay, first up, let's see where the man comes from. I mean, to really get his genius, you have to understand the foundation it was all built on. We're talking from a small village in Chhattisgarh all the way to the top of India's financial world. Now this, right here, is probably his single most important belief. For Kela, the stock market is not a place to make a quick buck, it's not for daily income, it's a powerful engine for building long-term generational wealth. That one little distinction changes everything about how he invests.
And his own journey just proves that his philosophy works. He started out in the early 90s, built up his experience, then made a huge market reliance capital. He was even named Fund Manager of the Year by the Prime Minister. And then he went on to start his own firm, MK Ventures. I mean, what a career trajectory.
So we know the investor, but who is the actual man? You know, understanding what makes him tick personally gives us some incredible clues about his investment psychology. So let's look past the numbers for a minute.
This is just great. Here's a guy who loves the simple things in life, right? The incredible voice of Mukesh, a good pani puri, and a movie with real heart like 3 Idiots. This tells you he's not some finance robot living in an ivory tower. He's grounded. He's relatable. He finds joy in everyday stuff. And this just says it all about his humility, doesn't it? His favorite song basically translates to, "I have learned everything except how to be truly smart." Think about that. That's not just a lyric for him.
It's a life philosophy. It's this deep understanding that true wisdom comes from knowing you'll never know it all.
So it's really no surprise that his go-to books are about human psychology, not just finance. He loves the psychology of money and thinking fast and slow. What this tells us is that he believes if you want to understand the market, you first have to understand people, how we think, how we feel, and how we make decisions, often irrational ones.
And that brings us to what I think is the real heart of his philosophy, his incredible take on mistakes. See, he doesn't see them as just bad math or a wrong call. He sees them as a direct reflection of who we are.
So I want you to just pause and think about that for a second. When you make a mistake in your investments, what's the first thing you blame? Bad luck? A bad tip? Well, Kela's answer is probably very different from yours.
And there it is. He argues that our own built-in traits, our ego, our fear, our biases, those are the real reasons we mess up. Sure, an education can give you knowledge, but it's your discipline, which comes from your personality and attitude, that really separates success from failure.
So here's the bottom line. Before you can ever learn a single thing from your mistakes, you have to have the guts and the humility to just admit you made one. If you can't get past that first step, you're just doomed to repeat it. It's all about managing your ego, plain and simple.
And he's noticed 4 common traps we all fall into. First, buying the right stock but not buying enough of it, a lack of conviction. Second, getting sucked into the hype, that classic fear of missing out, or FOMO. Third, ignoring that little voice in your head, that gut feeling that something's not quite right. And finally, getting so charmed by a CEO's story that you forget to look at the actual numbers. Okay, so we've got the philosophy down. Now, let's get practical. How does Kela take this awareness of human error and turn it into a disciplined, repeatable strategy that actually protects his money?
He has this brilliant way of categorizing mistakes. He says some errors are minor. They're just part of the game, the tuition you pay to learn. But others are fatal. They're like a heart attack for your portfolio. They can wipe you out. For him, the entire game is about avoiding those fatal errors.
So how do you do it? He's got a 3-part framework. First, manage your bet size. Keep your positions in check and have the discipline to cut them loose when you're wrong. Second, you have to rely on a consistent process to take the emotion out of it. And finally, you have to constantly reevaluate. You don't just buy something and forget about it.
I absolutely love this analogy. It just perfectly captures that stubbornness and denial that so many investors have. You see the facts turning against you, but instead of doing something, you just close your eyes and hope the problem magically disappears. That, for Kela, is a one-way ticket to a fatal error.
This right here is his golden rule for emotional control. He talks about a time when he let one position get so big that it completely stressed him out and clouded his judgment. He learned a hard lesson that day. You're managing a whole portfolio, not just one stock, and you can never ever let one failing stock sink the entire ship.
All right, so let's bring this all home. When you boil it all down, what's the big picture wisdom we can take away from Madhusudan Kela's amazing career and his journey of self-discovery? This is exactly why he's still so optimistic about India. Where most people see problems, potholes, traffic, he sees opportunity. This isn't just about finance. It's a whole mindset. It's about seeing the massive potential for growth and improvement precisely because things aren't perfect. It's an incredibly bullish way to look at the world.
And in the end, it really all comes down to this. His secret formula for success in the markets and in life is just to keep things simple. Don't overcomplicate things. Stick to the basics. Focus on what you actually know. It sounds simple, right? But believe me, it's not always easy.
So let's end on this thought. Kela's entire philosophy is built on this idea that you learn from your mistakes. He sees them not as failures, but as tuition that you pay to the market. So the question I want to leave you with is this. When you look back, what's been your most valuable mistake, and what did you really truly learn from it?
You know, when you talk about the real legends of the Indian stock market, there's one name that just screams wisdom and long-term vision, and that's Ramesh Damani. Today, we're going to unpack the philosophy of this absolute market veteran. And we're not talking about hot stock tips. Nope. We're diving deep into the 2 things that really matter in investing: how you handle mistakes and the importance of humility.
All right, let's get into it. We're really trying to get inside the head of a master investor here. In the market, they call someone like Damani a lambi res ka ghoda, a horse built for the long race. And the secret to running that marathon isn't about never tripping up.
It's all about how you get back on your feet. That's the core wisdom we're digging into today.
So, here's our game plan. We'll kick things off with his long-term perspective. Then we'll get into the psychological warfare every investor fights with themselves. We're going to tackle the ego, which is a big one. Then we'll lay out his practical playbook, and we'll cap it all off with the one asset he believes beats everything else. Good old-fashioned optimism.
So you have to wonder, right? A guy with more than 3 decades in the game, has Ramesh Damani made mistakes? Oh, you bet he has. Of course. But the real question, the thing that separates the greats from everyone else, is how did he handle them? How does a master deal with the fact that sometimes you're just going to be flat out wrong?
This right here, this is the heart of his philosophy. He actually borrows this idea from the Bhagavad Gita, and it completely changes how you think about failure. For Damani, a mistake isn't something to be embarrassed about. It's just tuition. It's the price you pay for an education from the best teacher there is, the market itself. It's a lesson you just had to learn to get to the next level.
And that whole idea of lessons, not mistakes, flows right into the psychology of it all. See, Damani is a huge believer that investing is just as much about figuring yourself out as it is about figuring out the market. It's an internal battle you have to win before you can win the external one.
He makes a great point here. For a lot of us, our upbringing pretty much hardwires us to be cautious. If you grew up in a middle-class home, your default setting is probably protect your capital, right? Don't lose what you have. Overcoming that deep-seated fear is honestly the first major hurdle for any aspiring investor.
And this just lays out the 2 big traps perfectly, doesn't it? When the market's flying high, we all get a little lazy, a little complacent. That whole "Deka Jayega, we'll see what happens" attitude creeps in. But the second the market turns, bam, fear takes over. Your survival brain kicks in, and all that rational thinking just goes right out the window.
And man, this is the real danger zone. When you're on a winning streak, you start to feel like you can't lose. You feel invincible. Damani warns that this is exactly when you start making dumb decisions. Not based on solid research, but on convenience, or worse, on pure arrogance. It's a trap that has humbled even the smartest folks out there.
So all of this brings us to what Damani believes is the single biggest enemy an investor will ever face, especially right after they've made a mistake. This is the one thing that can turn a small, affordable lesson into a complete and utter catastrophe.
Now, before I give you his answer, just think about it for a second. What's the most destructive force when it comes to your money? Is it a bad economy? Bad luck? Or is it something coming from inside the house?
That's it. One simple word. Ego. That burning need to be right. That stubborn refusal to admit you messed up. That right there is the true enemy of your portfolio.
And what a killer metaphor that is. The ego is a poisoned chalice. You know that holding on to that losing stock is killing you, but your pride just won't let you sell. So you keep taking a sip of that poison, day after day, while your losses get bigger and bigger. The only way to heal is to admit you were wrong and just put the chalice down.
Okay, so if we can get our psychology in check and tame that ego, what are the actual rules for playing the game? Let's dive into the Damani playbook. These are the real, actionable principles that have guided him for decades.
These are the absolute pillars of his strategy. Everything, and I mean everything, starts with valuation. What is a business actually worth? That's what lets you think for yourself and ignore the herd. We've already hammered home keeping your ego in check. Then you play where you're strong, and holding it all together is emotional stability, just staying calm and rational when everyone else is freaking out. Honestly, if you forget everything else, just burn these 3 golden rules into your brain. 1, diversify, so that one bad bet can't sink your whole ship. 2, do not use leverage. That means don't invest with borrowed money. And 3, always stay humble. The market has a funny way of teaching humility to anyone who gets a little too cocky.
His warning against leverage comes down to this simple, brutal piece of math. You could have a decade of amazing returns, but if you're leveraged up and just one of your big positions goes to 0, you can lose everything. Your entire portfolio gets wiped out because anything multiplied by 0 is always 0. It's a risk, he says, is just never, ever worth taking.
I love this quote. It's such a brilliant, witty way to explain one of the most powerful ideas in investing: play your own game. If you're not a chess grandmaster, why on earth would you challenge the world champion? It's just common sense.
And that's what he's talking about here. This is the famous circle of competence. It's the area where you have a real, genuine advantage. Maybe it's an industry you worked in for 20 years, or a type of business you just get, inside and out.
Real long-term success comes from staying inside that circle and resisting the urge to go play in someone else's sandbox.
And really, at the end of the day, it all comes down to this: total personal responsibility. Investing can be a lonely game. There's no one else to blame for your losses, and you get all the credit for your wins. You are the captain of your financial ship, period.
All right, let's pull back and look at the biggest picture of all. Because every single one of these rules and mindsets, they're all built on one foundational belief. One asset that Damani thinks is more valuable than any stock you could ever own.
Just look at this. Let this sink in. Over his career, Ramesh Damani has personally witnessed the Indian market Sensex go from a measly 800 points to over 80,000. When you've seen that kind of unbelievable growth with your own two eyes, it gives you a perspective that is just unshakable. It's the ultimate reason to have that glass half full mindset.
And that's why he says optimism is a non-negotiable trait for an investor. If you're in it for the long haul, every single market crash, every crisis, every wave of panic, it's not just something to survive, it's a fantastic opportunity to buy great companies on sale. The potholes on the road don't matter nearly as much as where the road is heading.
So, what do we walk away with? First, learn to love your mistakes. See them for what they are: cheap lessons. Second, the best medicine for a mistake is letting your winners keep winning through the magic of compounding. Third, stay resilient and keep that long-term optimistic view. And finally, for heaven's sake, do your own homework and trust your own brain, not the shouting of the crowd.
So, I'll just leave you with this final thought to chew on. Ramesh Damani's entire philosophy is built on this one simple idea: the market is the greatest classroom in the world, and your mistakes, they're just the lessons. So the real question you have to ask yourself is this: when the market's talking, are you actually paying attention in class? All right, today we're going to dive deep into the world of a true titan of investment management, Dr. Punita Kumar Sinha. We're going to unpack her incredible story to figure out what it really takes to not just play the game in global finance, but to actually win it.
You see this, and you know exactly what it means. The bull. It's all about power, optimism, the market charging ahead. It's a world of unbelievable opportunity, for sure. But it's also a place of chaos, risk, and, let's be honest, a lot of volatility.
So, here's the thing. Anyone can get lucky and ride a bull market for a while. But to truly understand what's happening beneath the surface, to navigate the chaos, what does that actually take? Is it just crunching numbers? Is it having nerves of steel? Or is it something else entirely? That's the question we're digging into today.
Okay, so here's how we're going to break this down. We'll kick things off with her groundbreaking career. Then we'll get inside her head to understand her investor's mindset. From there, we'll look at some tough lessons the market taught her, lay out her core investment philosophy, and wrap it all up with why a career of constant adaptation is the real secret sauce.
All right, let's start at the beginning. We need to understand the foundation of her career because this wasn't someone who just followed the trends. She was out there setting them.
Just let that number sink in for a second. 3 decades. That's not just a long time. That's a period that saw massive, world-altering economic changes. And Dr. Kumar Sinha wasn't just along for the ride. She was in the thick of it, building this incredible reputation for expertise and for work that was truly ahead of its time.
And what's so amazing when you look at this is just the sheer range of her experience. Back in the early 90s, when a lot of people were still scared of emerging markets, she was at the World Bank, literally helping to write the playbook for investing in them. From there, she's at huge firms like Oppenheimer, eventually becoming a senior managing director at a powerhouse like Blackstone. Then she spends 15 years running one of the biggest U.S. funds for India before taking all that knowledge and starting her own firm. You see, it's not a static career. It's a constant, powerful evolution.
And holding up this entire incredible career is an academic foundation that is frankly just rock solid. A PhD in finance from Wharton, it doesn't get much better than that. But look where it started. Chemical engineering from IIT Delhi. Think about that combination for a second. The rigorous, analytical, problem-solving mind of an engineer combined with elite-level financial theory. That's a powerful mix. So you've got the incredible career, you've got the top-tier education, but what's actually driving the day-to-day decisions? Let's get into our mindset, because great strategy doesn't just come out of a textbook, it's built from our experiences, and a lot of the time from the lessons we learn really early in life.
And this slide right here, this is where it all connects so perfectly. On the left, you see her upbringing, a family that went through the immense turmoil of partition where the values were all about education and just pure hard work.
That kind of experience fosters caution, right? Now look to the right. There it is, clear as day, reflected in her investment style. Systematic, prudent, risk-averse. It's a straight line from who she is to how she invests.
And this quote just says it all. When the markets are going wild, when everyone else is hitting the panic button, her entire approach is grounded in that caution she learned early on. It's not about knee-jerk emotional reactions. It's about staying calm, being systematic, and doing the research. That's how a prudent mindset turns into winning action. But you know, theory and mindset are one thing. The market is the ultimate classroom, and its lessons can be pretty brutal. This next part is all about how you take those tough moments, those setbacks, and forge them into real wisdom. Now here's a scenario I think every single one of us can relate to, whether you're a pro or just starting out. She had a stock that just did nothing for years, and that's an agonizing place to be. Do you stick to your guns and wait it out, or do you finally just cut your losses and move on? It's a huge test of your discipline.
Okay, now let's flip that coin. Imagine a completely different kind of problem. Imagine one of your stocks does this, 1,000% return. I mean, wow, that's the dream scenario, right? The absolute grand slam. You'd think there's no downside to that. Well, think again. The company was called Bangladesh Lamps. And after this unbelievable climb, the market for the stock just vanished. It became illiquid. There was nobody to sell it to. All of a sudden, that massive 1,000% gain was completely trapped. It was a huge profit on paper, but in reality, it was worth nothing because you couldn't get to it.
So let's just make sure we're totally clear on this term liquidity. It's actually really simple. It's just about how easily you can turn your investment back into cash. If you can sell it fast without tanking the price, it's liquid. If you can't find a buyer at any reasonable price, it's illiquid. And as this story shows, it is an absolutely critical make or break concept.
And there it is. That's the punchline. That's the hard-won lesson from that whole experience. That giant number on your screen, that 1,000% gain, it means absolutely nothing if you can't turn it into actual cash in your bank account. Getting out of an investment is just as important as getting in.
So you take all these experiences, the good, the bad, the painful, and you start to build a framework, a philosophy that guides you. So let's try and distill all this down into the core principles of her approach to investing. And here they are, the 4 pillars holding it all up. First, and this is huge, you have to have humility. Second, use the hard data, the quantitative analysis to keep your own emotions and biases from messing things up. Third, surround yourself with a diverse team that's going to challenge you. And fourth, and I think this one is often overlooked, having a balanced personal life helps you make more rational decisions professionally. I really want to pause on this first pillar for a second because it is so important. The market humbles even the most confident investors. It doesn't matter how smart you think you are or how much research you've done, the market can and eventually will prove you wrong. Arrogance is probably the single biggest killer of investment returns.
Now, this is a really fascinating and subtle point she makes. It adds a layer to that diverse teams pillar. Absolutely, you want to hear from everyone. You want to get all the different perspectives. But when it's time to actually make the call, you can't invest by committee. One person has to own that decision and be accountable for it. It's about collaboration, but it ends with decisive leadership.
Which brings us to our last section, because in a world that changes this fast, you can have the best strategy on paper, but if you can't adapt, you're not going to last. This is all about the lifelong, relentless pursuit of learning.
And this, to me, is just incredible. You look at this career, all the success, and she's still willing to talk about her regrets. She looks back at the 90s and says, you know what? I was probably too skeptical about India compared to other markets. I underestimated its potential. That's not a sign of failure. That's the sign of a true professional, someone who is constantly reevaluating, always learning, even from their own misjudgments.
So, if we boil this entire journey down to one final lesson, this is it. Mistakes are going to happen. They're just part of the game. So continuous learning isn't just a nice idea, it's non-negotiable. You have to be willing to adapt, to change your mind as the world changes around you. You've got to embrace the whole challenge with resilience.
And really, that's the story of her incredible career. It's about smarts, it's about discipline, and it's about wisdom that was earned the hard way. But more than any of that, it's a story about adaptation. So I'll just leave you with this question to chew on. In your own career, in your own life, in a world that refuses to stand still, how will you adapt?
You know, have you ever made a decision that felt absolutely perfect, only to watch it just completely blow up in your face? Or, hey, maybe you've been on the other side. You took a wild shot, a total Hail Mary, and it paid off big time, leaving you feeling like some kind of genius. Well, today, we're going to dig into why judging your choices purely by their results is one of the biggest and most common mistakes we can make. So let's explore this idea and see if we can all learn to make better, wiser decisions. And our guide for this journey is the man you see here, Sanjay Bakshi. He's an incredible investor and professor, affectionately known by pretty much everyone as Prof. Now, he has spent his career dissecting human behavior and investing, and he's got this powerful framework that can help all of us, not just in our portfolios, but really in our lives, make much better decisions.
So that really brings us to the big question, right? How do you actually know if you made a good decision or a bad one? Now, if you're like most of us, you'd probably just point to the outcome. You know, it worked out, so it was a good decision. But as we're about to see, the real answer is, well, it's a lot more nuanced and frankly, a whole lot more useful than that.
Okay, so here's our game plan. We're going to start with a core idea, a maxim from the professor, that's going to challenge how you think about success. Then we'll unpack a simple but really powerful tool called the decision matrix. From there, we'll dive into two fascinating real-life stories from Prof. Bakshi's own investing life. One that ended in a lot of pain, and another that looked like a massive win. And finally, we'll wrap it all up to focus on what truly matters, the process.
All right, let's get straight to the heart of it, the decision matrix. The best way to think about this is as a mental model, a tool that helps you separate the quality of your thinking from the pure randomness of the world. It's all about creating clarity.
And this whole framework really rests on this one powerful idea from Harvard professor Richard Zeckhauser. Good decisions sometimes have poor outcomes. Now, it sounds so simple, but it's profoundly counterintuitive. Think about it. As Prof. Bakshi points out, if you ask your friends about their best decisions, they will always tell you about the ones that had amazing outcomes. Nobody ever brags about that brilliant decision they made that ended in total failure, right?
And this little chart illustrates that point perfectly. This is the decision matrix. Just look at the two axes. You've got the quality of your decision on one side and the quality of the outcome on the other. Now, the top left and the bottom right boxes, those are the easy ones. We all get those. Good process, good outcome, hey, you did well. Bad process, bad outcome, well, you messed up. But the really juicy stuff, the interesting part is in the other two quadrants. Up here in the top right, a good decision with a bad outcome, that's just being unlucky. And down here in the bottom left, a bad decision with a good outcome, that's just being plain lucky. And it's in those two boxes where the most important lessons and, honestly, the biggest dangers are hiding.
So let's jump into our first case study. We're going to explore that top right quadrant, which is probably the most psychologically difficult scenario of all. When you do absolutely everything right, you follow the process to a T, and you still lose. This is the story of an investment in a company called VGL Products.
Okay, so the initial decision to invest here looked completely rock solid. VGL Products was this e-commerce company, had a really unique business model, a significant cost advantage, incredible returns on capital, and it was growing like a weed. And on top of all that, the stock was trading at a really attractive price. By any objective measure, the process that led to this investment decision was excellent.
But then, something totally unexpected happened. Out of nowhere, a competitor, just flush with private equity cash, storms into the market and starts acting completely irrationally. I mean, they weren't even trying to make a profit. They were just burning cash to grab market share, slashing prices, offering free shipping, the whole 9 yards. This kind of external shock just completely torpedoed the profitability of the entire industry, and VGL's stock price just collapsed. This was the bad luck.
And this left Prof. Bakshi with an incredibly difficult choice. The whole game had changed. This wasn't about just holding on and hoping for the best anymore. He had to completely reevaluate his decision based on this new reality. So he asked himself a really critical question. Knowing what I know right now, would I still buy this stock today?
And the answer, for him, was a clear no. So he did the disciplined thing. He sold his position, and he took a massive financial loss. But, and here's the painful twist, a few years later, that irrational competitor finally ran out of money and just faded away. VGL's business recovered beautifully, and its stock price multiplied many, many times over from the exact point where he had sold. I mean, what a truly gut-wrenching outcome.
So this brings up this crucial question, doesn't it? When you follow a great process and you still get a terrible, painful outcome, what are you supposed to do? I mean, your gut instinct is to go back and find something to fix in your process to make sure that never ever happens again, right?
But the correct and unbelievably difficult response is to do absolutely nothing. At least nothing to your process. See, the process itself wasn't flawed, it was sound. That negative outcome was simply the result of bad luck, a completely unpredictable external event. If you try to fix a good process to avoid every possible bit of bad luck, you're making a huge mistake. You'll just make yourself over-conservative, and you'll end up missing out on fantastic opportunities in the future.
And the legendary investor Benjamin Graham explains exactly why trusting the process over the long haul is so important. He said that while any single investment can go south, even a really sound one, if you make many such well-reasoned investments over time, it becomes almost a mathematical certainty that your total profits will outweigh your total losses. It's really the logic of the insurance business. You trust the process over the long run, not the outcome of any single roll of the dice.
Okay, so now let's look at the flip side, that bottom left quadrant. This is the case of getting rewarded for a bad decision. And this, my friends, is arguably even more dangerous. This is the story of Symphony Limited, and it is a masterclass in how good luck can blind us to our own mistakes.
So back in 2013, Prof. Bakshi invested in this company, Symphony. And on the surface, man, it looked like a dream stock. It was a consumer appliance business, making these just extraordinary returns on capital, growing super fast, and you could buy it at a low valuation. It was checking all the boxes.
And the outcome? It was absolutely fantastic. Over the next few years, the stock didn't just do well. It went stratospheric. It multiplied an incredible 70 times over. 70! He eventually sold his position for a massive profit. To the outside world, and even to himself at the time, this looked like a work of genius, a true home run investment.
But, and there's always a but, here's the catch. The process was flawed. In his analysis, Prof. Bakshi had overlooked one absolutely critical factor. The company had no real barriers to entry. There was no protective moat around its business to keep the competition away.
I love this quote from another investing giant, Philip Fisher, because it paints such a perfect picture. He compared high profit margins without any protection to an open jar of honey sitting out on a picnic blanket. It's sweet, it's attractive, and it will inevitably attract a swarm of hungry insects, competitors, all trying to get a piece of it.
And that is precisely what happened to Symphony. Long after Prof. Bakshi had sold and cashed in his winnings, new competitors swarmed into their profitable little niche. And just like that, Symphony's margins and its returns on capital were decimated. The good luck was simply in the timing of his sale. The bad process, ignoring that lack of a moat, was eventually exposed. That great outcome had dangerously masked a flawed decision.
So, after looking at both sides of that coin, the pain of bad luck and the danger of good luck, what's the one crucial thing we should all take away from this? Well, it all comes down to this: focusing on the process.
So here are the key takeaways you can start using today. First, and most importantly, judge your decisions by the quality of your process, not the outcome. Second, you have to accept that bad luck is just part of the game. Don't let a bad result fool you into abandoning a good process. Third, be your own toughest critic when you get lucky. A good outcome from a bad process is a dangerous, dangerous trap because it teaches you all the wrong lessons. And finally, you have to cultivate the discipline to know that a wise decision is wise because of the reasoning behind it, and then trust that over time a wise process will lead to better results.
And that leaves us with one final thought to chew on. I want you to think about your last big win, maybe in your career, an investment, your personal life, whatever. Take a really hard, honest look at it. Was that success the result of a sound, repeatable process, or did you just get lucky? The answer to that question could change everything about how you make your next big decision.
Welcome to The Explainer. Today, we're going to crack open the playbook of Rajiv Thakur, who is, without a doubt, one of the most thoughtful and resilient strategists out there in the world of investing. We're going to break down the mindset that lets him navigate the absolute chaos of the markets with such a steady hand.
Okay, let's just dive right in. The very first thing you got to wrap your head around is a huge shift in perspective. See, most of us, we think investing is like chess, a game of pure skill. All the pieces are right there on the board for everyone to see. But Rajiv Thakur says, nope, that's all wrong. Investing is actually poker. Think about it. You've got your cards, but you have no idea what your opponents are holding. You don't know what card is coming next, and you can play a hand perfectly and still lose to some lucky draw.
And this, right here, this is the core idea that his entire philosophy is built on. We all have this natural habit, right? We look at a trade that made money, and we say, wow, what a great decision. Or if it lost money, we think, man, what a dumb mistake. Thakkar argues this is totally backwards. A great process can still lead to a bad outcome just by bad luck, and a terrible process, it can get lucky sometimes. The whole key is to stop judging the result and really start analyzing the process.
So, how do we build this kind of unshakable mindset? Well, we're going to break down Rajiv Takkar's playbook into 6 key strategies. We'll start with redefining what a mistake really is and go all the way to the habits that build a long, successful career. Let's really dig into this first concept, because honestly, it's the foundation for everything that comes next. It all boils down to one absolutely critical skill: separating the quality of your decisions from the luck of the outcome. You know, there's a name for this mental trap we all fall into. It's called resulting, and it's such a human thing to do. If you win, you feel like a genius. If you lose, you feel like an idiot. Thakkar warns us that this is one of the most dangerous biases an investor can have. You know why? Because it stops you from learning the right lessons. You might just keep repeating a bad process over and over again, all because it got lucky once.
Here's a super simple way to think about it. Imagine I've got a coin, but it's weighted. It lands on heads 60% of the time. Now you decide to bet on tails, and hey, you win. So, was that a good decision? Of course not. Your process was flawed because you bet against the odds. The real mistake, what Thakkar calls an unforced error, was ignoring the probabilities. The process was the mistake. It doesn't matter that you got lucky on that one flip.
Okay, so if it's all about the process, how do you actually build a better one? Well, it doesn't start with spreadsheets and financial models. It starts with how you think, how you see the world, and just how broad your knowledge really is.
What's really interesting is that Thacker's journey into this way of thinking didn't begin with some dry finance textbook. It actually began with fiction. As a kid, he just devoured novels. And why does that matter? Because great fiction is like a masterclass in human psychology, our motivations, our emotions. It teaches you empathy, and it gives you this incredible insight into how people act under pressure, which is an absolutely essential skill when you're dealing with markets driven by fear and greed.
He really lives this wisdom from Da Vinci. A true strategist doesn't just stay in one little box. They connect ideas from history, from science, from art, from psychology. It's the same approach you see from giants like Charlie Munger, who famously talked about using a latticework of mental models from all these different fields. The goal isn't to force the world into one simple framework, it's to see the world as it really, truly is.
And this way of thinking leads us to one of the most powerful, proactive tools in Thacker's entire arsenal. It's built on a really simple idea. Most people wait for a crisis to happen and then they react. A strategist prepares for it when things are calm.
This is the pre-mortem. It's a simple, but man, it's a profound shift in thinking. So instead of asking your team, hey, what could go wrong with this? Which usually gets you polite, quiet answers, you start from a totally different place. You say, okay, team, it's a year from now, this investment has been a total disaster. We've lost everything. What went wrong? This just frees people up to be truly critical and honest, and you end up uncovering risks you would have totally missed otherwise.
So this process, it creates a plan of action before the crisis even hits. For instance, during a pre-mortem, you might decide way ahead of time, okay, if another pandemic-like event happens, we're only going to invest in companies with rock-solid balance sheets. We'll avoid anyone with a high risk of going bankrupt. When you have that framework ready to go, you can act decisively while everyone else is running around panicking.
And this just perfectly illustrates the concept in action. You know, Warren Buffett's legendary calm during the 2008 financial meltdown, that wasn't a superpower. It was the result of preparation. He had a predefined philosophy, his own version of a pre-mortem plan, which was to buy excellent, cash-rich companies when they went on sale. So when the crisis finally hit, he didn't have to think. He just executed the plan he'd made when times were good.
So crisis planning is one thing, but what about the hundreds of decisions you have to make every single year? How do you stay disciplined and avoid those unforced errors on a day-to-day basis?
Well, Thacker relies on a set of really practical, repeatable tools. These aren't complicated theories, they're just concrete actions designed to cut down on his own biases. Each tool has a specific job, to stress test his own thinking and to get emotion out of the equation.
Take the checklist, for example. It seems so simple, right? Almost too simple. But as the surgeon Atul Gawande showed in his fantastic book, The Checklist Manifesto, even the most seasoned experts can dramatically improve their outcomes just by using one. It forces you to cover all your bases. A simple question on that checklist, something like, have I clearly written down the 3 biggest risks to this investment? Forces you to face the downside before you put your money to work.
Now this is another critical tool.
It's so easy to surround yourself with people who agree with you to create an echo chamber. Thakkar does the exact opposite. He actively, intentionally seeks out the voice of dissent. He'll invite people who hold the completely opposite view to come in and just tear his thesis apart. This is the ultimate defense against confirmation bias because it forces you to look at the weakest spots in your own argument.
Now, look, despite the best process in the world and all the best tools, you are still going to make mistakes. It is absolutely inevitable in a game of probabilities like poker. So the next critical step is making sure that when you are wrong, it doesn't take you out of the game for good.
Thakkar boils survival down to 3 non-negotiable rules. These are like the structural pillars that make sure no single mistake can be a fatal one. Position sizing controls how much you can lose. Diversification protects you from putting all your eggs in one basket. And avoiding leverage, that makes sure you can never ever lose more money than you actually have.
And the math on this is just brutally simple. Let's say a stock is 1% of your portfolio, and it goes to zero. It's painful, sure, but your whole portfolio is only down 1%. You survive. But now imagine a stock that's 50% of your portfolio goes to zero. Your capital just got cut in half. That is a complete disaster that can take years, maybe even decades to recover from. Proper position sizing is your #1 defense. It ties how much you invest to how confident you are, while always respecting that even your best ideas can be wrong.
Okay, finally, let's look at the engine that drives this entire system, a relentless, non-stop commitment to learning. A great process isn't something you build once and then it's done. It has to evolve, it has to adapt, and it has to get better over time.
A critical skill you develop over a long career is being able to tell the difference between a real signal and just noise. A signal is information that genuinely changes your entire thesis about an investment. Things like discovering corporate fraud or realizing a business model is fundamentally broken. Noise is pretty much everything else. The monthly sales data, the quarterly earnings miss, all that constant chatter on TV and online. A great investor learns to act on the signal and completely ignore the noise.
Thakkar is a deep believer in this idea. By studying history, by reading biographies, and even mythology, like the story of Icarus flying too close to the sun on wings made of wax, we can start to recognize the timeless patterns of human behavior. The technology changes, the company names change for sure, but the underlying drivers of hubris, fear, greed, and just plain foolishness, they are eternal.
And that leaves us with a final, and I think a crucial question. The real value of this playbook isn't just to understand Rajiv Thakkar. It's about applying these lessons to our own lives. It's a call to action, really. To stop reacting to all the daily noise and to start listening for those rhymes of history, not just in the markets, but in every big decision we have to face.
When we think about investing, we usually picture these titans of finance, right? People in $1,000 suits barking orders on a trading floor. But what if I told you one of the sharpest minds in the market looks more like your neighbor, loves street food, and finds lessons about stocks in old Hindi songs? Today, we're pulling back the curtain on Satya Prakash Mittal, a man whose simple life hides the mind of an absolute master. We're going to dig into the principles that made him a quiet legend.
Look at this. The bull, it's all about power, right? Momentum, pure optimism. But that energy, it doesn't just happen. It's harnessed by the people who can stay disciplined, who understand the psychology, and who never, ever stop learning. We're about to get inside one of those minds to see what really makes the engine of success run for decades.
I mean, just let that sink in for a second. He's quoting Warren Buffett, but by saying he was late at age 11, well, that tells you everything. This wasn't just a job he picked up. For him, the market was a calling, something he felt he was born to do, and he felt like he was playing catch-up from day one. That's passion.
So here's the game plan for today. First, we'll meet the man himself. Then, we'll see how his investor brain was wired from a young age. We'll get into his strategy for dealing with market craziness. And then, and this is the best part, we'll dive deep into his philosophy on making mistakes. We'll wrap up with his day-to-day process and what he sees coming down the road.
So who exactly is Satya Prakash Mittal? Well, he's the kind of guy who remembers the exact date of his first investment, December 29th, 1980. Think about that. That's not just a transaction you remember. That's the day your life's journey really began. And what a beginning it was. His very first stock pick, a company called Ambala Sarabhai, jumped 50% in just 3 months. On a small investment of around 2,250 rupees, he made more than 1,000 baht. Now, for a kid just starting out, that kind of return, that's not just profit, that's a lightning bolt. It was a revelation that showed him the incredible power of the market and lit a fire that, well, it's still burning today.
And this is why his story is just so great. He's not some robot staring at a screen. He's a guy inspired by The Godfather. He'll stop everything to tell you about his favorite street food. He literally finds metaphors for investing in old songs. It's just a fantastic reminder that a brilliant financial mind doesn't have to fit into some Wall Street mold. They can come from anywhere.
Okay, so how do you build a mind like that? It doesn't just pop up out of nowhere. For Mittal, it was hammered into shape by the little lessons of his childhood, way before he ever placed an official trade.
What's so cool about this is how each of these things was like a different building block. It started back in the 60s, just watching his dad invest. That planted the first seed. Then, at school fairs, he learned about profit and loss in the real world, running his own stalls. Even his grandfather's stamp collection, that became a hands-on lesson in how value can grow slowly and steadily over a lifetime. But maybe the biggest lesson? When his father lost money on some company deposits, Mittal didn't just get upset. He got curious. He wrote letters, he dug into the bad financials, and he learned, firsthand, what a failing business looks like from the inside.
And that's how he puts it himself. These weren't lessons from a book. This was real life. It taught him about business, about patience, and about the absolute necessity of understanding a company's health. It was an education you just can't buy.
You know, investing isn't really about math. It's about managing your own emotions. It's about staying cool when everyone else is either terrified or way too greedy. And Mittal came up with a simple but really powerful playbook for handling the market's wild mood swings.
Okay, so look at this contrast. This is everything. Most people, we react with our gut. The market crashes, we panic and sell. The market is booming, we get greedy and buy at the very top. Mittal just flips that completely on its head. For him, a crisis isn't a disaster, it's a discount sale. And a market high isn't a time to pile in, it's a time to sell and take some profits. It's classic contrarian thinking.
And here's his system, plain and simple. It works in any market. When things are just chugging along, he slowly buys shares in great companies. When the market goes crazy and everyone's euphoric, he doesn't try to guess the peak, he just sells a little bit on the way up. And when the crash finally comes, he sees that volatility as his best friend. It's a tool that lets him buy those same great companies at bargain bin prices, again, in a very disciplined way.
All right, we're getting to the absolute core of his philosophy now. And honestly, this might be the most valuable lesson for any of us. It's all about changing how you think about being wrong. For Mittal, mistakes aren't just something to avoid. They are the entire curriculum.
Just think about that for a second. A mistake isn't an F on your report card. It's a sign. It's the market telling you, hey, maybe you should double-check your work here. It's a chance to learn something new and get better. He truly believes the longer you're in the game, the more of these learning opportunities you get. And that's how you build real, unshakable confidence.
Now, it's one thing to talk about a philosophy, but a real-world story makes it stick. And boy, does Mittal have an incredible one. It's about a company called DLF and how a massive mistake became his single greatest teacher. And, funny enough, led to a huge win. Let's just walk through this, because it's like a Hollywood movie. It's 1994, he owns 700 shares. Then, bam, fear hits. The company says it's going to delist, which basically means you can't trade the shares anymore. Panic everywhere. So his reaction is what most of us would do. He sells almost all of it, 690 shares, and locks in a small, safe profit. But then, something stops him, a little bit of intuition. He decides to keep just 10 shares, just to see what happens. And the reward for that little bit of patience? It was unbelievable. Through splits and bonuses and all sorts of corporate actions, those 10 shares ballooned into 4,400 shares.
And this slide just lays it out so clearly. The mistake, the decision based on fear, got him a tiny profit. But the lesson, those 10 shares he held onto out of sheer curiosity, they became worth around 36 lakh rupees. He basically sold a winning lottery ticket for a few bucks. The pain of that near miss was a much, much better teacher than the comfort of that small gain ever could have been. And there it is, right from the man himself. That experience wasn't a regret. It was a source of courage. It taught him to look beyond the daily noise, to ignore the scary headlines, and to truly understand the long-term value of a business. And most of all, to be patient. That one single mistake changed how he invested forever. Okay, so if that's the philosophy, how does he actually put it into practice every day? Well, it's not about waking up and having a gut feeling. It's about having a disciplined system that favors data over drama and process over panic. His whole day is built around this system. It starts with meditation, not CNBC. He gets his head clear. Then he looks at the data.
all before the market even opens. He uses tools like screener.in to systematically hunt for ideas, not just chase whatever's hot. And his research is deep. I'm talking reading every single annual report, listening to every call, even sending his own questions to companies. But here's the key. He doesn't do it alone. He has a network of other smart investors to kick ideas around with, challenge his thinking, and help him learn from his mistakes. And that whole process leads to this, a portfolio with over 300 stocks in it, which is pretty surprising, right? A lot of famous investors say to put all your eggs in a few baskets. But for Mittal, after that painful DLF lesson, he'd rather spread his bets far and wide. For him, it's not just about minimizing the risk of one company going bust. It's about minimizing the risk of missing out on the next big winner entirely. So after all these years, after all the booms and busts, all the lessons learned, what does a guy like this see when he looks at the future? Well, when he looks at India, he is incredibly optimistic.
I mean, listen to that. A super duper phase. That's coming from a guy who's been investing since 1980. He's seen it all. And he's saying this is the best he's ever seen it. He believes stable governance and a real focus on growth are creating a once-in-a-generation opportunity. He thinks the number of investors in India could triple in the next 5 years alone, bringing a huge wave of new money and energy into the market. At the end of the day, Middle Story isn't just about making money. It's a lesson in humility, in curiosity, and in the wild idea that your biggest failures can actually become your biggest strengths. His entire career has been one long learning process, powered by the guts to be wrong. So he kind of leaves us with a question, doesn't he? What are we willing to get wrong so we can learn how to get it right? All right, today we're getting into the mind of a real giant in the Indian equity markets, Hiran. Now, you might think we're going to talk about his 30 years of incredible wins, but nope, we're going a different route. We're going to talk about his mistakes. Why? Because as Hiran himself will tell you, the most profitable lessons, well, they almost always come from getting it wrong. And that's the real story here. I mean, think about it. In a world like high finance, it's easy to focus on the wins, but the truly great ones, the ones who last, they learn from the moments they get it spectacularly wrong. And Hiran, he's practically built his entire career on mastering that exact process. And there you have it, straight from the man himself. It's so true, isn't it? In our personal lives, you might make a decision and not know if it was a mistake for, years, decades? But in the market, phew, the verdict can come in minutes. It is a brutal, lightning-fast feedback loop, and knowing how to handle that, well, that's everything. All right, so here's how we're going to break this down. First, we'll get into the anatomy of a mistake, what actually goes wrong. Then we'll look at the investor's toolkit for bouncing back. We'll tackle this idea of commission versus omission, super important. Then we'll go beyond the balance sheet to the human side of things. And finally, we'll see how all of this ties into the massive opportunity he sees in India. Let's get into it. Okay, so let's start at square one. When a guy with 30 years in the game makes a mistake, how does he even think about it? Well, it turns out Hiran doesn't just lump them all together. He splits them into two very, very distinct categories. So on one side, you've got what he calls impulsive mistakes. These are the ones you make in total chaos. You know, when the world feels like it's ending. Think the COVID crash, think 9/11. Pure fear, pure greed, just raw emotion driving the bus. But then you have mistakes of misjudgment. And these are almost the opposite. They happen when everything's calm, when you've got all the time in the world. But your thinking, your core analysis, it's just plain wrong. Let's look at a real-world example, the 2008 financial crisis. Ved made a decision that, on the surface, seemed totally logical. He thought, okay, I'll sell my high-quality, expensive stocks because they have the furthest to fall. Makes sense, right? But he was wrong. What he learned, the hard way, was that in a real crisis, the market doesn't care about the price tag. It cares about cash flow. The companies with the strongest financials bounced back the fastest. A perfect, painful example of a mistake of misjudgment. All right, so you messed up. The market slapped you with its verdict. Now what? You can't just curl up in a ball. This is where we get into the practical side of things, the toolkit and the mindset that Ved has built to handle and recover from these unavoidable mistakes. And honestly, it comes down to this super simple but incredibly powerful two-step process. Step one, accept. Just accept it. You have to check your ego at the door and just admit reality. My thesis was wrong. This investment is a dud. Simple as that. Because only after you do that can you move to step two, adapt or correct. Sell the thing, change your whole approach, whatever it takes, and move on. It sounds so easy on paper, but trust me, getting past your own ego is usually the hardest battle you'll fight. Look, recovering from a mistake is good, but you know what's better? Not making it in the first place. And for that, VOD has this kind of multi-layered defense system. It all starts internally, with just constant, ruthless self-reflection. But, and this is key, he knows he can't trust himself 100%. So he builds what he calls an unbiased ecosystem around him. He surrounds himself with critics, with friends and colleagues who are not afraid to tell him he's wrong. And then, as a final safety net, he's got objective, data-driven risk management frameworks. It's a system designed to catch mistakes before they happen. But here's a tricky question, and you've probably thought about this. What happens when a mistake eventually turns out to be right? You know the situation, you make a call, it immediately goes against you, but you stubbornly hold on, and then boom, sheer luck saves you. So was it still a mistake? Well, according to Heron Ved, the answer is a hard yes. It was still a mistake. For him, it is always about the process, not the outcome. If your process is good, it should prove itself right in a reasonable amount of time. If you have to just hang on and pray that circumstances bail out your bad choice, you're not investing anymore. You're just gambling. And this focus on process leads us right into the next big idea. Because see, not all mistakes are the same. Ved makes this really important distinction between two ways you can be wrong. And they each come with a very different kind of pain. First, you have your error of commission. This one's easy to understand. You buy something, it goes down, you lose money. It's right there on your statement in bright red. It's a direct hit. But then there's the error of omission. And this one is sneakier and sometimes way more painful. This is the opportunity cost. It's not about the money you lost, it's about the money you failed to make because your cash was parked in a loser instead of a winner. And here's a perfect example of that hidden cost in action. Ved talks about holding on to a losing stock like Thomas Cook for way too long, just hoping it would turn around. Sure, the direct loss he took hurt, but the real pain, the agonizing part, was the opportunity cost. He had to ask himself, what could that money have been doing for me if it wasn't tied up in this mess? That's the error of omission. It's a silent killer. So we've covered process, frameworks, different types of mistakes, all the technical stuff. But what about the person sitting in the chair actually making the calls? This is where we go beyond the balance sheet and get into the human factor. So, is investing purely analytical? I mean, is it just about the numbers? The simple answer is absolutely not. If it was, we could just write a bit of code and all be millionaires, right? Hiram Vat is adamant that what separates the good from the truly great isn't a smarter spreadsheet, it's having a better handle on yourself. It all starts with what he calls EQ, your emotional quotient. He says it's totally non-negotiable. Your physical health, your mental health, they directly impact your professional decisions. There's no separation. You also have to be just brutally honest with yourself. You can't run from your mistakes. And this last one is so important. You have to be non-judgmental when other people screw up. That's the only way you create a space where everyone feels safe enough to learn from their blunders. And you know, this isn't just some theory he preaches. He actually lives it. He's an introvert. He'd rather be in nature than in a crowded city. He loves old music and simple comfort food. And this isn't just random trivia about the guy. It's the whole point. He's showing us that having a calm, grounded, simple personal life is what gives you the strength to handle the absolute chaos of the market. Okay, so what happens when you take this whole philosophy, learning from mistakes, being resilient, having that psychological strength, and you zoom out? What if you apply it not just to a portfolio, but to an entire country? This is exactly how Hiran Ved's hard-won wisdom shapes his incredibly optimistic view of India's future. And he has this amazing metaphor for it. Just listen to this. India is a runner without shoes. It's such a powerful image, right? And it perfectly captures his whole point. It's not a knock on India. It's a statement about its incredible, jaw-dropping, untapped potential. And his logic is actually pretty simple and really compelling. He's saying, look, if this country has managed to achieve so much despite all the obstacles, all the challenges, I mean, it's essentially been running a marathon without any shoes on. So just imagine. Imagine what happens when you finally give that runner a decent pair of shoes. He sees all those past struggles not as a weakness, but as the very thing that forged the resilience and the hunger that's going to fuel its future. And as we start to wrap up, Ved leaves us with this really sobering thought about the responsibility of his job. He's very clear. Managing other people's money is not a game. It's a profound responsibility. And to do it right, you need honesty, you need deep conviction, and you have to have faith in yourself. But the real art, he says, is finding that delicate balance. knowing how to celebrate your wins while also having the humility to own your failures. Which really brings us right back to where we started. Why do we make mistakes, even someone with 30 years of experience? It's because we're human. Our minds aren't perfect. There will always be variables we can't predict, things we can't possibly know. So the goal isn't to be perfect. That's impossible. The goal is just to be resilient and to never, ever stop learning.
So I'll leave you with this final thought, really a question to ask yourself. Forget about your biggest win for a second. Think about your biggest mistake, the one that really stung. What did that mistake teach you? And more importantly, how did it make you better?